Good morning, everyone. It's 9 a.m. live from the Nasdaq market site in New York City. I'm Brad Smith alongside Shauna Smith. This is Yahoo Finance Live. Here are three things that you need to know to start your morning. Higher for longer is the name of the game, it seems. Fed Chair Jay Powell making clear that the central bank is almost done raising rates, but next year could see fewer cuts than previously indicated. The Bank of England, the BOE, also making waves this morning by leaving borrowing costs on a hold in a tight split decision. Now, that's the first time that they haven't raised the benchmark rate since November of 2021. It comes after a surprise fall in inflation.
We are on strike watch again, and there's some traction in Hollywood, it seems. Negotiations between screenwriters and studios resumed Wednesday and will continue today, with reports suggesting a deal ending the month-long standoff could be nearing. It's a different story, though, when you look at the UAW and Detroit's Big Three, with no breakthrough yet ahead of Friday's deadline. Stellantis has come to the table with a new contract proposal, but UAW President Shawn Fain has yet to greenlight it.
And well, the shutdown isn't averted yet, but the House GOP does seem to be making some ground in negotiations with holdouts. Embattled Speaker Kevin McCarthy proposing a new measure which includes deeper cuts, despite the fact that any offer is expected to die in the Senate. Just getting agreement on a spending proposal has proven difficult. The 30-day stopgap funding bill would set the current government spending level at $1.48 trillion a year.
Well, today's backdrop, the Fed is not the only central bank making decisions. We've got Switzerland, Norway, and England's latest rate decisions out today, and Japan later this week. Plus, there may be some movement on the front lines for the UAW and the Hollywood strikes. And there's that possible government shutdown less than 2 weeks away, a bit concerning here for the markets and the implications for the broader economy.
And so as we think about the markets, today's market driver, Federal Reserve Chair Jay Powell. The Fed held interest rates steady at a 22-year high on Wednesday while signaling another rate hike will be needed later this year to bring inflation back to its 2% target. Fed officials see significantly tighter rates through 2024 than previously expected. JP Morgan Chief Executive Officer Jamie Dimon had a few thoughts on the Fed's latest policy decisions, as Dimon is expecting the Federal Reserve will most likely keep increasing interest rates in the coming months to combat persistent inflation. Dimon saying the U.S. Central Bank was, quote, a day late and a dollar short in beginning to raise rates. Now, we should note that some of these comments that came at the Detroit Economic Club were just ahead of the Fed's most recent decision, but still very much encapsulating how the leader and the head of the largest U.S. bank here is thinking about the Fed's action. And as we mentioned, saying that the central bank was a day late and a dollar short, but also saying that odds are higher that they will have to go higher than they are today, and that on the rate policy front, talking about 4 months from now, 6 months from now, that inflation will be at 4%, and it won't be coming down for a whole bunch of reasons. That also part of the commentary that Jamie Dimon had offered.
Yeah, we've heard similar types of warnings here from Dimon, especially when you take a look at what he has said over the last 6 to 12 months, right? Talking about all the uncertainty, the headwinds facing the economy, and also the Fed's very tough fight here in trying to get inflation under control while avoiding a recession. Now there's more and more questions about whether or not the Fed is going to be able to do that, to orchestrate a soft landing if we're going to be in this higher for longer environment through 2024. So that is starting to really move the markets here this morning. We saw the reaction in the markets yesterday following that announcement, but it was a similar sort of narrative to what we heard from Chair Powell yesterday, right?
Yeah.
Chair Powell was routinely saying that we need to be very careful. I think careful was mentioned numerous times during the press conference yesterday, reiterating the fact that obviously the Fed remains data dependent. They're going to wait to see what the data shows them on inflation, what the data shows them on the job market, and continue to make those decisions off of the latest data points that we are getting. But still, we're in this very uncertain environment. And we're also seeing that reflected in the market reaction. When you take a look at the CME Fed Fund futures, yes, Powell was loud and clear, but the market, not every investor is buying what he's saying.
Yeah. One thing I do want to do, I want to go kind of like Dippin' Dots on this, if you will, and really dive into what some of that other commentary, and we've got a little bit of that from the head of the BlackRock Global Allocation Investment Team, as well as Chief Investment Officer of Global Fixed Income, Rick Reeder, over at BlackRock, saying that the median dots for the year-end 2024 suggest 50 basis points in policy rate cuts from the 5.6% median of the September projections for the 2023 year and Fed funds published today. Now, that was less than the market had been pricing in, but the market has also backed up the 2024 kind of rate cut pricing by 40 basis points since the beginning of September. So all of this considered, the data from here, he's saying, will be the Fed's guide in terms of direction of travel, as Chair Powell suggested in his speech at Jackson Hole, as well as reiterating yesterday.
All right, let's talk a little bit more about this. Higher for longer. That is what the Federal Reserve is saying to expect on interest rates going forward amid its battle to contain inflation. While the FOMC declined to raise rates at its most recent meeting, keeping it steady at a 22-year high, the dot plot showing that most Fed officials still think one more hike is necessary before the end of the year. On this, we want to bring in Esther George, former Federal Reserve Bank of Kansas City CEO and President. Ms. George, it's great to have you here. Thanks so much for taking the time to join us. So I think investors are still digesting what we heard from Chair Powell yesterday. But when it comes to those projections, right, that was the main focal point. The fact that officials still think that one more hike might be necessary before the end of the year, and we could be in this higher for longer environment through 2024. What's your reaction to that?
Yeah, well, good morning, and thank you for having me. I think as you look at the messaging coming out of the Federal Reserve, and again reiterated yesterday, this is a committee that wants to keep the focus on its restrictive policy bringing down inflation. They have been very clear that they want to get back to that 2% target. It's proved to be a little bit tougher in terms of a timeline for doing that. And so the messaging yesterday, including the dots, I thought were really trying to keep the focus on higher for longer in order to bring that inflation down.
Does this sound to you like a Fed that believes firmly in that a soft landing is going to be achieved?
Well, you heard the chairman ask that a couple of times yesterday. And clearly, this committee does not want to damage the economy. They would love to see those imbalances between demand and supply work their way out to a soft landing. The truth is, though, that isn't guaranteed. And really, the goal of that committee is to restore price stability. A soft landing would be a scenario where they're able to do that with little impact to the labor market. And you see that in their dots. On the other hand, they have also said there could be some pain involved in trying to restore price stability. And that pain typically comes in the form of a higher unemployment rate. So I think they're looking at a variety of scenarios at this point. They're getting close, they think, but not yet ready to say they've arrived at the destination.
Ms. George, what do you think is most likely at this point, given what we heard from the Fed yesterday? Do you think a soft landing is more likely, or maybe we'll see the other scenario that we've been talking about a hard landing?
So as I look at the outlook for the economy, clearly the consumer has been resilient. But I am also watching the fact that these excess savings, this money that has really shored up the consumer over the last few years, is waning at this point. We also see the uncertainty coming from strikes by auto workers and others. We see the threat of a government shutdown. And we also see globally that some of our trading partners are in a weaker position than we are with their economies. And so all of those things, to me, are a confluence of areas to watch that could hit the economy at some point. And finally, I would say, when you have this kind of a rate hike, 500 basis points plus, at a time when the Fed is also shedding its balance sheet, you are getting restrictive policy. And as that works its way through the economy, that, of course, can create some downdrafts. So I'm looking at a number of things that threaten that soft landing scenario. I think they're legitimate. I hope they don't come about. It would be great if the soft landing were the outcome. But I think the reality suggests that we need to be focused on what some of those risks are.
And when we think about what the Fed was expected to talk about coming into this meeting, oil was expected to be on the docket of conversation. Do you believe that we got any clarity about how the FOMC voting and committee members are looking across where the range of prices are that consumers are incurring and businesses are incurring as well for producing goods, and saying and assessing the broader oil or energy portion of those costs too.
Yeah, I think you're right. And I have to believe this was a central part of their conversation yesterday. We'll see when the minutes come out in a few weeks how they were judging energy markets, for example. But you're right. Anytime energy and food prices are at the levels they are today, they are hitting the consumer directly. And even though the Fed can look through those headline numbers and look at the core, we do know that higher energy costs when you pull up to the gas pump and fill your car is front and center in the minds of consumers. It does impact their ability to pay for things, to make trade-offs, the same with food prices. So those two things are very salient in the mind of households in terms of how they look at forward inflation, in terms of how good they feel about the economy. And I think today we know from looking at various consumer surveys, consumers don't feel very good about the economy. And that most certainly has to do with those prices in particular that they're facing.
Do you think then we'll see a further deterioration in the consumer? Because up until this point, the consumer has remained so resilient. When you compare what we're seeing today to what we were hearing from forecasters 6 to 12 months ago, we're looking at a totally different scenario.
Yeah, no, that's true. The thing in the favor of the consumer right now is the low unemployment rate. So to the extent that people have jobs, their wages have been going up, that gives people confidence and they will spend. On the other hand, we know that a lot of the demand we saw coming through the pandemic came from these excess savings, money that was transferred from the government's balance sheet to households and small businesses is running down. And the question is, will the consumer hold on to that in a cautionary fashion? Will they continue to spend out of that excess savings? Will they begin to borrow to maintain this level of expenditure while prices are high? Remains to be seen. But I think you have seen some moderation in consumer behavior, and I think we will continue to see that over the coming months.
And just lastly, while we have you here, as we think about the potential for a cut at some point next year, if you're sitting in the committee and you're thinking about what is going to, at the other side of whatever type of landing we do get, spur demand, drive people back into the housing market, how soon would you be anticipating or thinking about a cut?
Well, it's hard to pinpoint the time frame for that, but I think some of the things that this committee might be looking for is what happens in the labor market. The labor market gives a signal of whether demand has fallen in a way that causes businesses to turn loose of people. And of course, right now, we don't see that. In fact, just the opposite. People are hanging on to their workers because of how difficult it was to attract and retain them over the last few years. So I think pushing out the expected rate cuts is probably right, given the scenarios we've seen. On the other hand, I think at the end of this year, you could begin to see the impacts of the uncertainty around this government shutdown, around some of the strikes and the shutdowns that have happened in the auto sector. There could be other things as this tighter policy works its way through that will signal the economy is cooling in a way that the committee will not only be comfortable leaving rates, but anticipating those cuts sometime in the first half of next year.
That's really interesting what you were mentioning about the auto sector as well as we're continuing to track developments around the strike with the UAW and U.S. automakers as well right now. Esther George, we'd love to continue the conversation at a later date. Former Federal Reserve Bank of Kansas City CEO and president. Thank you so much for taking the time here today.
Thank you both.
Absolutely. Well, switching gears here, we're also tracking shares of FedEx. They are on the move here this morning. Its latest earnings out after the bell yesterday. Shares are higher by about 4.6%. The company beat on profit in the second quarter and raised its full year guidance. Now, FedEx attributing its strong quarter to its ongoing Drive program aimed at boosting profitability by boosting revenue and lowering operating costs. Now, Allison Poliniak, who is the senior analyst at Wells Fargo Securities, wrote in a note that as FedEx's transformation efforts continue, macro headwinds could challenge profitability in the near term. Her team raising their price target, though, to $280 from a previous of $270, remaining equal weight. Allison Poliniak joins us now. Allison, great to have you here with us today. I want to get kind of a broad read on the earnings, what you took away. Were you kind of confident in what you heard from the executive team, or did it just further solidify some of the kind of glaring signals that are or red flags that might jump out to your team?
Yeah, so good morning. Thanks for having me. So clearly, as you mentioned, execution was the highlight in the quarter, drove a significant amount of the upside, just given some of the tepid volumes that we're seeing in the parcel volume area. As we kind of step back, that execution is really key in our mind. We have no idea what that macro is going to look like as we kind of move forward. But the execution that FedEx is doing with their Drive program is certainly, giving some results to the company, driving earnings in this tepid volume environment for them.
Allison, how big of a risk is this higher for longer environment that we heard about from the Fed yesterday? The fact that could really potentially weigh on consumer spending and then, of course, hit companies like FedEx. How are you assessing that risk?
Well, you even look at FedEx's earnings raise. Really, they just raised the low end of the guidance. So at the midpoint, they raised their guidance about 25 cents. They did keep the top end of the guidance, and it's really, reflective of sort of the concerns that you have out there today. And if you look at the revenue guidance, they did actually, even though they raised the low end of the guidance, they did lower the revenue guidance. And a big part of that's attributable to the consumer weakness out there today.
When you think about all of the different input costs that this company has to manage, we had heard from some of the airlines how they're navigating fuel expenses. Is that something that also is a headwind risk to the costs for FedEx?
It's certainly something they're always worried about. I would say they typically manage it through surcharges. So we would expect them to be able to pass that along to their customers.
How much more does that mean that we might be paying, or that the end consumer might be paying for, those fresh Jordans to get delivered, or that, online order that is probably an overnight splurge? I'm not outing myself. I'm just saying other people who might be doing that.
Well, as you know, their pricing is moving higher, right? They already put out their rate increase for next year. They expect to capture a big piece of that, up around 5%. So, that will certainly continue to play a role in parcel demand and delivery costs going forward as well. So I would not expect it to come down materially, unfortunately.
Allison, we saw a little bit of a benefit there from UPS troubles. When we take a look at the ground division, 400,000 additional packages per day by the end of the quarter. This market share gain that we saw FedEx have this most recent quarter, is that something that you think they're going to be able to sustain?
Yeah. So when we talked to them, the significant diversion from UPS this quarter, what their approach was really try to lock that diversion, those volumes into maybe a longer term contract. So it's not going to be easy, quite honestly, for UPS to pull it away. FedEx does acknowledge that some of it likely does kind of revert back, but they expect to hold on to the capture that they had this quarter.
In this kind of more mature phase of growth that you believe FedEx has entered, and transformation strategy, where would you say that they are at in that broader kind of time span or range, and where do you expect that we can actually see that start to trickle through to their financials?
Well, I would say, for one, take your first question last, is really you are starting to see, if you look at the incrementals in ground, they were north of 100% in terms of, what they were able to achieve there. I would say they're still very much in the early innings, right? Express on the other side, they're still trying to kind of balance that supply and demand. Then the next leg is really that network 2.0, where they're integrating that express and ground networks. That will take time, but, I would say you still have a substantial runway over the next 5 years for them to right size and reorganize that cost structure.
So, Allison, you have an equal weight rating on this stock. You did raise your price target by $10 to $280 a share, just above where it's trading today. What do you need to see in order to be a bit more bullish or more convinced about FedEx's position?
Yeah, I would say our confidence on the execution side has certainly increased here, just even given the most quarterly results. It's clearly the macro, right? The consumer, we're about to head into peak season here. All signs are pointing to a very muted peak season, just given the consumer concerns. I would say a little bit more confidence in where we're going on the consumer side. Clearly, the incrementals and the inflection, FedEx is setting that foundation to certainly achieve, strong earnings power coming out of this whenever that happens.
Does weakness in a consumer that thinks more about the possibility of a recession or even more of a pullback among their discretionary spending, does that trickle through to FedEx this holiday season from your estimation and from what you're hearing from the executives? Are they expecting, or at least baking into some of their own expectations, that we could see a consumer that decides, all right, we're not making the same amount of purchases as last year, despite what some of the forecasts may say?
Sure. I mean, from a sequential standpoint, we are going to look for absolute volume increases, right? We will be spending on the holiday. The question is that year over year increase. And at this point, what we're looking towards is a muted peak, so roughly flat with a year ago. So some volume, improvement, but not significant enough that's going to drive a huge, I would say, key peak season. Certainly something they're watching for. They're trying to be agile in case that does happen. But at this point, the consumer side and to the point of the revenue and the volume declines that FedEx is kind of trying to be prepared for in that outlook. It's certainly something we're watching, but right now the companies we've talked to, including FedEx, it's really going to be this very muted peak season, probably similar to what we saw last year.
All right, Allison Poliniak of Wells Fargo Securities, senior analyst there. Again, of FedEx shares up nearly 5% here in pre-market trading. Allison, thanks.
Great, thank you.
Well, we've got all your market action ahead live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance.
We're tracking Fox shares today after Rupert Murdoch has announced that Rupert will be stepping down as chairman from Fox and News Corp this morning. That announcement was made in a memo, and his son, Lachlan Murdoch, will become chairman of both companies. Joining us now, we've got Vanity Fair correspondent and hoax author Brian Stelter. Brian, good to have you here with us on this. Just want to get your reaction to this. Finally, some semblance of a succession plan that's come forward, perhaps, but now we're continuing to watch shares here in reaction to exactly what this means for News Corp and Fox.
Right. Rupert Murdoch always famously said that he would never retire. In fact, his son, Lachlan Murdoch, said the same thing almost a decade ago. He said, "My dad is never retiring." But today is the closest thing we will ever see to Rupert Murdoch retiring. He is handing over all the power for the first time and the only time in his career. And this does confirm the succession plan that had appeared to be in the works for many years. Lachlan Murdoch had clearly been the favored son, the chosen son, ever since the 2015, 2016, 2017. Son James Murdoch has completely left the companies. He hates what Fox News has become. So now Lachlan Murdoch will be the sole chair of both Fox and News Corporation. And of course, we should face the facts. This is happening as both companies are in a shrinking period. They are in a shrinking phase. They are trying to grow, but like many other media companies, they are facing headwinds involving streaming, involving digital subscriptions, involving the death of newspapers. So I suppose, to be frank, these jobs are not as fun as they were when Rupert Murdoch was the swashbuckling media mogul of decades past. The job has shrunk in some ways for his son Lachlan, and now Lachlan moves forward on his own.
Brian, what do you think this is going to have, or if any, impact on the strategy at Fox and News Corp, the direction of those two companies? How do you see that changing, if at all, with this?
I think the number one question would be about editorial vision, and I think Lachlan and Rupert are very much in alignment on that. Lachlan Murdoch is as conservative, or in some cases more conservative, than his father, so I would not expect dramatic changes editorially. On the business strategy, we have seen Lachlan Murdoch trying to expand in streaming with Tubi, for example, at Fox Corporation, and with News Corp, pressuring Facebook and Google to pay up for digital content. I would expect those moves to continue. I think the longer-term question is what happens to these companies in the event that Rupert actually passes away and is no longer in charge of the Murdoch Trust. Even though he is stepping aside today, he still has 4 votes out of 8 in the Murdoch Trust. That ultimately controls both companies. In the event of his death, each of the 4 adult children have 1 vote each. Lachlan would only have 1 vote, as far as we know, unless something's changed today, and we have no reason to believe that it has on that front. So I would expect, potential reorgs, reshuffling, changing of assets, only in the event Rupert passes away, not at this moment in time.
Would this reinitiate any talks around the merger between Fox and News Corp?
Yeah, I've been wondering that in the past few minutes as well, and I haven't heard clear guidance from sources on that yet. My initial reaction is that large shareholders were significantly opposed to the re-merger of News Corp and Fox earlier this year, late last year, earlier this year. T. Rowe Price, for example, large shareholder in News Corp, said this is a bad idea. James Murdoch also weighed in and said this is a bad idea. So Rupert uncharacteristically backtracked, walked away, gave up on the proposal. There is certainly going to be conversation about whether that's going to be rekindled. I wouldn't see it happening imminently, though.
Brian, when you take into account the fact that he does have this emeritus status, I mean, from your time, from your colleagues, who you've spoken with in the past, how involved do you think he's still going to be in some of these decisions?
Yeah, it's a complex picture that we saw through the Dominion v. Fox lawsuit, because through that lawsuit, we were all able to see thousands of pages of emails and text messages, including from Rupert Murdoch. And there are some times when he seems like an active, involved owner, someone who's really interested in the content, reading all of his newspapers, watching Fox. There are other times in those emails where he seemed incredibly passive, where he was not all that engaged, where he was not steering the ship. It was more like he was just in the back of the ship, taking in the view, enjoying the view. I would say that is, at 92, that is the Rupert Murdoch that comes through most days now. Someone who is not in the front, not the captain of the ship anymore. And, perhaps this announcement this morning just confirms what has been true for a little while, that he is no longer the man who put fear into the hearts of so many executives for decades. I'm working on a book called Network of Lies about Fox and Murdoch and Trump. And one of my sources for the book said to me, there was a time, decades ago, there was a time when Rupert would say jump And everybody around him would say, how high, right? We know that expression. The boss says to do something, people will do it no matter what. But the point my source was making was that time has come and gone. That time has passed. He no longer commands that power. Now, whether his son Lachlan can command that power, whether his son Lachlan will be feared and revered and reviled in the same way, I suppose that's the start of the chapter we're talking about today.
Certainly a new chapter there for News Corp and for Fox. Brian Stelter, always great to get your perspective on this. Vanity Fair correspondent and author of Hoax. Thanks, Brian.
Thank you.
We want to get to the opening bell on Wall Street, and let's do a quick check of the market sponsored by Tasty Trade. You're looking at all three major averages under pressure as investors digest what we heard from the Fed and Chair Jay Powell yesterday. The Dow starting the day off just about 100 points. Jared Blickery is here with a closer look at some of these moves, Jared.
Yes, if you take a look at the Wi-Fi Interactive, you're going to see a lot of red on your screen right there, and that's only today. You check out the last 2 days, and it's even worse. Google, Alphabet now down 5%, Amazon and Nvidia down 4% over the last 2 days. I think there is a big reaction to the higher rates that we're seeing develop today in the markets, and basically long duration tech, that is growth stocks, they are suffering, and the generals are getting shot right now. Let's take a look at the sector action. Only energy is in the green. You can see it there. XLE up about 0.75%, but everything else in the red. And the mega cap sectors of consumer discretionary, tech, real estate is not mega cap, but also communication services. All of those are on the bottom row there. And let's just take a look back at the Nasdaq and chart some of the action that we're seeing here in Apple, for instance, over the last 3 months. I've been concerned about breaking this 175 support here. It looks like Apple may be on the verge of doing that, but it hasn't happened yet. Also want to go back and check out some of the larger action within the indices. Here's the US dollar index. We're not going to do that right now. Here's the S&P 500 over the last year. You take a look over the last 3 months. We are not at the bottom end of this range, but you take the equal weight S&P 500, where every stock, gets one vote, and we are now breaching that line. Russell 2000 has broken down, and then you take a look at the VIX. Volatility is heading up, and the VIX heading north is not a surprise. That's something that happens this time of year. I've been sharing this VIX seasonality chart with everybody over the last few days. This shows that over the next 2 weeks in early October, we usually get a VIX spike, and that is exactly what's happening right now. I do see some potential for resumption of the uptrend in equities in the broader indices in October, but let's not get ahead of ourselves first. It's a really risk-off day here in the Nasdaq studio in New York.
All right, Jared, thanks so much for tracking all of that. Of course, much to continue to keep an eye on as we move on throughout the rest of today's trading activity. Jared kicking off the day's trading session with us. Thanks, Jared. Let's take a look at our market movers this morning as well. Broadcom is where we start things off. Those shares are certainly in focus among investors, as according to a report this morning, Google has discussed dropping the company as their supplier of AI chips as early as 2027. Now, that's from Reuters. Reportedly, Google plans on designing the chips in-house. This comes after a months-long standoff between the two companies over Broadcom's price for the chip. You're taking a look at Broadcom shares this morning. ABGO is the ticker symbol there. These shares are down by about 3.5% under pressure as a major partner or a major kind of historical deal that the two companies have had in place. Certainly any kind of deterioration of that relationship would have a direct impact to the financial results of a company like Broadcom here.
Yeah, Brad, you're exactly right there. And it could obviously potentially, if this in fact report is true and does come to fruition, it could slow growth there at Broadcom. It could essentially cost the company billions down the line. We know that this is such an important relationship for Broadcom when you take into account the business that Google has been giving the company as their AI chip supplier. If we do see the two break apart, the question is, who is Google going to turn to in the interim, right? We are seeing some movement in Marvell Technology, and the information reporting there that Google could potentially be working on a move to Marvell Technology for the chips that are connecting services to the Ethernet switches. So we'll see whether or not that happens. I also thought that part of the report, fact that we could eventually see Google try to build something in-house. Obviously, similar-esque to what we've heard from Apple, trying to bring their chip production in-house. Exactly what that means and the timeline of that, obviously, lots of questions there.
Certainly. We'll be watching that close.
All right, we've got all your markets action ahead live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance. New market research from UBS showing consumer demand for soft goods is weakening. Now, the investment firm bearish on clothing stocks due to a weaker spending outlook for all things clothing, outerwear, and linens. We want to bring in the author behind that note, Jay Soul, UBS's North America Soft Lines and Luxury Analyst, joining us now. Jay, it's good to see you. So you and the team were out talking to consumers, asking them about their spending plans over the next several months. What did you find?
Yeah, well, thanks for having me on the show. What we found is that consumers are really feeling cautious. They're still seeing a lot of inflation. They're worried about things like having to repay student loans. And as a result, they're thinking that they're going to pull back on spending on discretionary items like apparel, footwear, and accessories. And we think that's going to be a headwind for stock prices.
Yeah, I mean, certainly sounds like it, Jay. Who are some of the companies that could be most impacted by this in your purview?
What's interesting is I think that really all the softline companies are going to be impacted, whether we're talking about department stores or brands or, off-price retailers or mall-based retailers. What we're seeing is a broad-based slowdown, not just among, say, specific income demographic groups, but it's really across all income demographic groups. And really everybody buys clothing. So it's something that we think is going to impact the group as a whole.
Jay, are we going to see more promotional activity as a result?
Absolutely, for two reasons. Number one is that there's still too much inventory out there. I think retailers have been surprised by how slow demand has been already this year, and that's created a little bit of a buildup of inventory. But then going forward, we think that demand is going to slow down even more. So even though retailers have taken a more cautious view on the amount of inventory they've bought for the Christmas shopping season, they're still going to have too much. And when there's too much inventory out there, that leads to promotions and discounts because that's what retailers have to do to sell it.
In your note, you talk about some of the companies with the best go-it-alone growth potential, Nike, On Holding, Deckers. Walk us through the thesis there and how you're kind of defining this go-it-alone strategy.
Yeah, so that's a great point. The stocks we like are the brands that can really distribute their goods and sell directly to consumers, meaning through their own stores, their own websites, and essentially cut out the middleman. And that's a way to sort of increase profits and have a more direct relationship with consumers. Brands like Nike companies like Nike have invested, literally billions of dollars to improve their direct to consumer business, to make their apps more appealing for consumers to shop at. And we think that's the wave of the future. We saw a little bit of rebound in store traffic the last couple of years as the world reopened after the pandemic. But what we've seen during the back to school shopping season is that online sales growth rates are starting to pick up. We're starting to see that market share shift back to online. And that's, we think that's the wave of the future. And that's how these companies that you mentioned are positioned. And that's one reason we really like them.
Do you think that that's going to drive a pricing reset? Maybe not all out promotional, but maybe kind of rejiggering of how they strategize what prices they're going to market with some of these products, because I mean that's where I think about it. Sure, I would love to buy a pair of Jordans for less than $200. Am I going to be able to do it? Not all the time. So at the end of the day, do you think that there's going to be a reflection within their own strategy of recognizing the consumer environment and saying, okay, maybe we do need to moderate lower on some of these prices, even if we do know that there is some of this strength that we have through the direct-to-consumer efforts that we've had?
Well, that's a great point and something that companies think about a lot. And the Jordan example is a great one because Nike wants to obviously raise the price of Jordans, but they don't want to raise the price without making the consumer feel like they're not getting great value at the same time. And so what that depends on is innovation. Nike wants to make sure when they make a new Jordan that they bring something new that excites you and makes you want to spend $200 for that Jordan. As long as they do that, their ability to maintain high prices and the consumer's willingness to spend that kind of money on Jordans will continue. And that's really what's going to drive the margins and the profitability and the earnings growth for Nike over time. Whether they sell the product through their own stores or websites or through a retail partner like Dick's Sporting Goods, it sort of doesn't matter. What does matter, as long as that product is great and the innovation is there and the marketing is great, then Nike can really control the prices and consumers are happy to pay for it.
Jay, we're going to hear from Nike. The results are on deck next week. What are you expecting to hear from them? Because we know last quarter they did disappoint the street with their profit number coming in below expectations. Gross margins also falling to 43.6%. Are we going to see a bit of a turnaround or still too early?
Well, we have a really bullish view on Nike long term. We have a buy rating on the stock. But, to your point, I think you're absolutely right. It's a little bit too early. In the near term, I don't think this quarter is going to be a catalyst that really gets the stock to start to rise. We think that if the last 3 months, the overall consumer spending environment in the US and China have been a little bit slower than expected, and that probably limits Nike's ability to raise its guidance. And if they can't do that, there's probably not a lot of upside to the stock price in the near term over the earnings event.
Jay, it's so interesting when we look across the landscape and kind of like factor in what you're putting out in this note here. I can't help but think about a company that's getting ready to go public in this environment, and that is Birkenstock. And of course, as you're still waiting for them to make it into the public markets here and ultimately, hopefully, we'll see, make a splash or not, it's a larger question of the consumer environment that they're entering into as well. How does this impact a company in investors' minds that hasn't even made it into the public markets yet, but is looking to hopefully maintain some mind share among consumers as well as potential investors?
Well, I don't have any comment on Birkenstock. I have, nothing to say there. But what I can say is that if we look at a company like On Holding, which you mentioned before, or a company like Deckers, which is the owner of the Hoka sneaker company, what we do know about the environment is even though it's challenged out there, consumers are still spending enough that brands that have great momentum and that have great products can still perform really well and take market share. So that's one reason we like On Holdings. We have a buy rating on that. And it's another reason that we have a buy rating on Deckers and we like that stock. So there's a couple names that are still doing really well. On is taking market share. And that's, we do think those trends continue for those brands that really have great momentum.
All right. We will see exactly what that spells out, not just for all the companies that you mentioned, of course, for Birkenstock, who we took some liberties and also entered into the conversation here, admittedly. Jay, great to have some time with you this morning, and thanks for breaking down the outlook and the thesis for us. UBS Softlines and Luxury Analyst Jay Soule. Thanks, Jay.
Thanks so much.
Absolutely. Everyone, switching gears here. Yahoo Finance's executive editor, Brian Sozzi, joins us now. Over to you, Brian, with some big news today.
All right. Thanks so much, Brad. Indeed, some big news. This morning, Cisco announced it will acquire cybersecurity leader Splunk in a deal worth approximately $28 billion. I'm joined by Scott Herren, Cisco's chief financial officer. Scott, good to see you. Just heard you on the investor call moments ago. Big deal. And I think your company is saying this is a historic deal for Cisco. Walk us through it.
Yeah, it's unusual when you get this kind of a great combination of two companies at scale where you have great product fit, great strategic fit, great cultural fit. The valuation is in line with what we expected, and the financial details are tremendous for us. So it's an exciting day for us.
It's also, I think, just a marker in your company's history in that you are now really in services. Your model is changing. How should an investor view Cisco? Not just a router company. You also have a lot of recurring revenue.
That's a really good point. And over the last several years, we've accumulated about $24 billion worth of annualized recurring revenue, to your point, on the services model. Splunk has that same model. Splunk will bring another $4 billion of ARR to us. So besides the great product fit and the opportunity to really help our customers move from, on the security side, from detect and respond to predict and prevent ahead of time. So yeah, pretty exciting transaction.
I love talking to CFOs on deal days. So, because I can ask you, what are the synergies? Do you have a number when this deal closes? How much in cost synergy? How much in revenue synergy? And is Splunk profitable?
Splunk is profitable. Gary Steele came in as the CEO about 18 months ago. And Gary and I have known each other for years. He's a tremendous operator and has done a great job, I think, over the last 18 months. Kind of focusing more on cost, focusing more on profitability, focusing on customers. And they've made some really key decisions that I think helped us get to the point where we are today of making this transaction. It's an opportunity for us to not only drive the product synergies we've talked about and take their product set through our go-to-market channel. If you think of the global footprint that Cisco has, Splunk's revenues today, Gary said on the call, roughly 2/3 are still U.S., right? So the opportunity to take that technology and to leverage our footprint, something we're pretty excited about. We will do some additional investment to make that happen in both Europe and in APJC. And yes, of course, we've got synergies, more top-line synergies than there are cost synergies as we look forward.
Yeah, is it more So this isn't a deal where you join forces and suddenly you put out a release saying you have hundreds of millions in cost synergies. This isn't that type of deal?
No. This is much more motivated by the top line synergies and acceleration we can get. And frankly, cash flow positive in year one after close. We do expect there to be a 9 to 12 month standard regulatory review. There's very little product overlap. So I don't think there's concern there. So when I talk about the cash flow positive in the first year post-close, for us, that's our fiscal 25, right? We expect this to close right around the beginning of our fiscal 25.
So 9 to 12 month regulatory review. It was mentioned on that call, Splunk has a little business in China. Do you need China's approval for this deal to close?
We do not. They've got a very, very small business in China, so that's not going to be an inhibitor to us.
What's the big play here? Of course, we've been talking to you, and I talked to your CEO, Chuck Robbins, a couple weeks ago on generative AI, and you have already a big backlog, hundreds of $millions in backlog. Is the play here to keep people's data secure as Gen I gets supercharged?
Yeah, you're spot on, Brian. Data is the key to AI, right? If you think about that, without you need the data to train the models to get the value out of AI. So what this gives us a chance to do, Splunk, of course, is a source of data for literally thousands of companies around the world. When you can combine that with the network telemetry and the security telemetry that we have, and with our AppD product, right, which gives you application monitoring, you can pull all that together in a very rich data set and then put an AI layer over the top of that. So it's not, what you were talking about earlier is more us selling AI infrastructure. There's also an opportunity for us to build AI into our products and to enable our customers to leverage AI, and that's the real opportunity here.
When you talk to customers and potential customers, is that their biggest fear with Gen AI, that we're moving so fast and nobody's protecting the stuff?
I think everybody's still trying to figure out Gen AI beyond, write a poem for my wife kind of thing in ChatGPT. There's no question that those large language models will have broad applicability across every company, and that applicability will come down to training the model. And training the model requires data, and that's why this is such a powerful transaction for us.
Isn't this the biggest deal that you've signed off on as CFO? What is that like?
This is definitely the biggest deal that I've signed off on as a CFO. And as you can imagine, we spend a lot of time on this. We've always been disciplined.
It's been talked about for a while in various forums.
It was rumored, I think, if you go back, and that was before Gary joined the company. But for a transaction this size, we've always been disciplined. We are an acquirer as a company. We've always been very disciplined, and we were here as well. But we spend a lot of time on diligence, understanding the company, understanding the cultural fit, understanding the product fit, understanding the customer overlap, and the opportunity to actually take this technology and build on top of it and take it more broadly across the planet.
Before the pop in Splunk shares on this deal, about a 30% plus premium compared to Splunk's closing price yesterday, if I did my math right, hopefully I did. What are they working on that is so exciting that you're paying a 30% premium?
Well, it's a company that has great financial metrics, right? And again, I give Gary a lot of credit for the work that he's done to get it to that point. But we'll be cash flow accretive in the first year, even with a transaction of this size. And by the way, the metrics are right in line with precedent transactions. So you're right, it was about a 31% premium to the spot price yesterday. It was right in range on a 30-day VWAP multiple or premium, and on a trailing 12-month revenue multiple. So right in line with standard metrics, but we can pull this in and be cash flow accretive in the first year with nominal EPS dilution, immaterial.
Does this change how you buy back your stock? You've also been a voracious buyer back, of a company buying back their stock. Do you change that?
I'm so glad you asked that question. It does not. And we said that on the call this morning, but I think it's a great point to reemphasize. Doesn't change our dividend policy of steadily increasing that. It doesn't change our buyback. We've talked about keeping it at this elevated level of about $1.25 billion per quarter. We've talked about keeping it there. We'll continue to. And that's the big advantage of being able to have the strength of our balance sheet, being able to do a transaction at this scale and have it be cash flow accretive in the first year post-close.
Was it tougher to do this or announce this deal today after a Fed meeting where the Fed chair said basically we're going to leave rates probably higher for longer? There's debt associated with this deal, right?
There will be. As we get to close, it'll be a combination of cash and debt to get that closed.
Are you worried about the returns you can drive from an acquisition like this? Let's say it closes later next year in a land where rates are not being cut and you have to fund this debt and the economy might slow, not just in the U.S., but around the world.
I don't think so. As I talk to my peers, CFOs at other companies, I think we're all monitoring the environment, and I think it's a good time to be prudent. We're being prudent at Cisco. I think everyone else is being prudent. but they're not stopping. They're not shutting down their business. They're not shutting down what they have to do to continue to grow their businesses. So no, by the way, you can't ever time what's going to happen with the FOMC, so I would never try to do that, and I don't think that's what you're suggesting. The overall macroeconomic environment is one that's not super robust, but it's also not one that is causing a significant slowdown.
What's your biggest challenge to integrating a $28 billion deal?
We'll spend a ton of time on that front, and I think one of the things that we really looked at during diligence is the strength of the leadership team that we're getting. The talent throughout the company is very strong. The leadership team is quite strong, and that'll obviously help us as we work through the integration process.
Well, good luck on that integration process. Thanks for always giving us time. Cisco CFO Scott Herren, you're about to be a very, very busy man. Not that you weren't before.
Yeah, I wasn't playing a lot of golf before, Brian, and this is going to kill my golf.
Yeah, absolutely will. All right, Scott, good to see you. Appreciate it.
Cheers, Brian. Thank you.
All right, all your markets action straight ahead, live from the Nasdaq market site. Stay tuned. Big day for the markets. You're watching Yahoo Finance.
We're live from the Nasdaq market site. It is a diplomatic showdown between India and Canada. India's visa processing center suspending services in Canada after Prime Minister Justin Trudeau accused India of murder on Canadian soil. So why is this worth keeping on your radar? We've got the answer to that question with Yahoo Finance's own Rick Newman joining us now with more. Hey, Rick.
Hey, guys, this is a crazy story. So this all started in June when masked gunmen assassinated a Canadian citizen living in British Columbia, Canada, who's from India and who India describes as a Sikh separatist who is trying to help establish a sort of a new country in northern India. So just recently, Canadian Prime Minister Pierre Trudeau said he thinks Indian agents actually carried out this murder, and this has set off this giant row between these two countries. Now, who knows what the actual facts are? Trudeau has said, look, we just want to get to the bottom of this. And for transparency, we're just saying what we think we know, which is to say agents of the Indian government killed a Canadian citizen in Canada. That is the allegation. And if true, that's a big deal. You don't go around killing people in other countries if you're a respectable country. So this matters a lot because India is now the world's most populous country. It's growing by a lot, whereas China's population is shrinking. It's in addition to being the world's largest, having the most population, it's the world's largest democracy. And it's a very important counterweight to China, in Asia. So relations between India and Canada and the whole rest of the sort of Western world matter a lot. Both governments are now sort of sticking out their chests and huffing and trying to say, how dare you? So this is kind of standard for this type of thing, although I mean, we haven't seen much of this really since like the Cold War. So this will probably all settle down at some point, but it really remains to be seen. I mean, it's fascinating if India actually sent somebody to conduct an assassination in another country. That would be quite remarkable.
Would be quite remarkable, and also a story that we're going to continue to follow. But Rick, I know you're also closely following another headline out here from Poland. Switching a little bit, they've long been one of the staunchest, or viewed as one of the staunchest allies of Ukraine, but they're beginning to pull back their support of Ukraine. What can you tell us there?
Yeah, this is another tussle between two countries. So Poland has said they're going to stop providing arms to Ukraine, which is a huge about face because Poland has been one of the most staunch defenders of Ukraine in its war with Russia. But this has absolutely nothing to do with the war. Believe it or not, it's all about farmers in Poland. And the political dynamic here will be familiar to people who follow American politics. There's a lot of grain coming out of Ukraine. It used to go through ports on the Black Sea. It cannot get out that way now. So there's a lot of cheap grain that Ukraine is trying to feed into Europe. And guess what? Poland has its own grain farmers. And for protectionist reasons, Poland is saying we're not buying cheap grain from Ukraine. And there are some other Eastern European countries that are kind of saying the same thing. So there is an election in Poland on October 15th. And my best guess is that a lot of this is posturing and this will all sort of settle down. But it is important to keep this coalition supporting Ukraine together, especially as we're now seeing here in the United States. I mean, this is becoming a political issue and a campaign issue in the 2024 presidential election. Should we keep sending billions of dollars of aid to Ukraine? The answer is yes, we should. And the United States has a good job keeping Ukraine's allies together, and it needs to continue to do that.
All right, Rick, excellent analysis as always here on Rick's Radar. By the way, we had mentioned yesterday that it was all hands on deck trying to get an animation figured out for you. When I say all hands on deck, it literally was all hands on deck. I decided to make sure that I took matters into my own hands. I brushed off the old PowerPoint slides in Google.
Where's
what
the
you
rest
use.
of
You
it?
look so proud of yourself in that.
I am. Wait for the zoom in. Here we go. This is the animation for you, Rick. Bingo. Money.
Okay. 1998 was a great year for technology.
Was. Yahoo purple right there in the background. I don't know if you noticed that. But we got you locked in. We're ready to go here, man. Thanks.
High tech, man.
Exactly. That's
I'm
all we
glad
do.
you guys have my back.
Got you covered, Rick.
Always count on us.
Yeah. All right. Thanks so much. We'll talk to you later, Rick.
Bye, guys.
All your markets action straight ahead, live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance. Welcome back. You're watching Yahoo Finance Live, everyone. I'm Brad Smith alongside Shauna Smith at the Nasdaq market site in New York City. We're about 30 minutes into the trading day. Let's take a look at how things are shaping up right now. First and foremost, stocks extend their losses after the Fed decided to hold rates steady at yesterday's meeting. The FOMC remains hawkish, signaling another hike before the end of the year here.
And looking at individual names, we can see KB Homes under pressure today despite reporting better than expected fiscal third quarter earnings and raising its full year revenue forecast. Now, the home builder did see homes delivered and the average selling price fall in the quarter while expenses rose.
And shares of Marvell, they are rising today as reports suggest that the chip designer could replace Broadcom as the key supplier to Google for AI chips. The tech giant plans on designing these advanced chips in-house. This comes after a months-long standoff between Google and Broadcom over chip prices, which could allow Marvell to step in.
And we're also watching cybersecurity company CrowdStrike, and you can see moving to the upside here in early trading. Now, this coming after the company announced at a cyber conference briefing that it's raising its target for subscription gross margins by 400 basis points, also boosting its operating margin target from 27% to 32%. The company is saying that they will expect to meet those targets in 3 to 5 years.
Well, we're with you live from the Nasdaq market site, and a few of the things that we are tracking here this morning is the market's commentary of the day. Goldman Sachs equity strategist David Kostin and his team is where we begin some of that commentary. They see the labor market limiting U.S. consumer stocks. The firm expects the equal weight consumer discretionary sector to underperform its S&P 500 counterpart by 7 percentage points in the next 12 months. Kostin saying in his note, "We forecast equal weight consumer discretionary returns because Amazon and Tesla account for 50% of the cap-weighted sector."
Well, the Fed has sent a clear message that rates will stay higher for longer, with another hike likely needed before the end of the year. Still, though, according to the CME Fed Watch tool, investors are pricing in an almost 70% chance that Powell is going to hold rates steady in November, and more than 50% of traders betting that they see the current rate for December, too. So here with more on that, we want to bring in Peter Chur. He's Academy Securities Head of Macro Strategy. We also have Young Yu Ma, BMO Wealth Management U.S. Chief Investment Officer. Great to see both of you. Peter, let me start with you because Powell, at least to me, was very clear in his message, yet the market still doesn't seem to be fully buying in. Why do you think that is?
I actually don't think he was quite that clear. I think what he's clear to me is it's an extremely high hurdle for them to cut. So they're not going to cut. But I think it's actually a pretty high hurdle for them to hike even more than once. And I don't even know if they get there. I think they're going to be very data dependent. And when they say data dependent, they always have a bias. And for much of the last 2 years, the bias was any data that gave them an excuse to hike, they were going to take that. I think they're looking for any data that says, hey, we can wait another month, we can wait another meeting or two to do anything. That's what they're looking for. And I think the market's going to deliver that sort of mixed data.
Young Yu, what do you believe here as we get another meeting or two, we get that much closer to next year and where the Fed ultimately decides where a hold or perhaps even a cut should be entering into the conversation?
Well, definitely still data dependent whether or not the Fed raises rates again. I think, as was mentioned, that cutting rates is a far out prospect at this point and really one that's off the table. And that's something that also markets are reacting to. But I think also the headwind in markets right now and why you're seeing that pricing in the futures market not believing that the Fed's going to cut rates is because I think the futures market is seeing all the headwinds right now that the economy faces, with student loan repayments resuming, auto and credit card delinquencies rising, the looming government shutdown or possibility of that, high oil prices. I think the markets realize that these headwinds are very meaningful and real here.
Peter, sticking with what Young Yu just had to say about oil prices, right? Obviously, this could be a real challenge for the Fed trying to get inflation under control. How do you view that risk to the broader market and what that could signal even for the economy as well when you factor in consumer spending?
I think on oil prices, they're going to be very reluctant to try and deal with oil prices through monetary policy. I think they realize that doesn't work. It's not sure whether it's demand driven, whether out of China, maybe out of India, our own supply. I think they're going to be patient. You're starting to see domestic air travel slow. I think you're seeing the economy here slowing enough that they're not going to worry about it. I think you've got to be until January or February before they start looking at oil. Remember, last year it went up to around these levels as you headed into winter in Ukraine and Europe, right? They're going to still deal with that war. So I think it's an issue they're keeping an eye on, but only one eye at this point.
Peter, just to follow up on that, and of course, the Fed, as they had put it yesterday, at least in the commentary, coming out of their meeting from Fed Chair Jay Powell saying nominal wage growth has shown some signs of easing. Job vacancies, they have declined so far this year. Job to workers gap narrowing, labor demand exceeding the supply of available workers, and then also expecting this rebalancing in the labor market to continue, easing some upward pressure on inflation. How quickly should we be anticipating or expecting some of that rebalancing in the labor market to persist and thus kind of be a driver of easing the inflationary pressure?
I think it's really going to be persistent right now. I think some of the data was overstated. So you've seen in NFP all these downward revisions. I did love the fact that you finally saw labor participation pick back up. And to me, you almost get this vibe out there that people who are sitting around saying, hey, I can get a job anytime I want, saying, maybe I can't. Maybe I better start looking for one right now. So I think the number of, these low-skilled, low-paying jobs are diminishing a little bit. People have moved on. So I think we're going to see weakness. I think we're going to see downward revisions. And I think that's going to be very supportive for the Fed to not do anything, at least.
Young-Yu, what are your chances when we talk about the probability of being able to orchestrate this soft landing? How probable do you think that is?
We still have that as a base case, which we've had for well over a year now, but I do think there are multiple headwinds. And Chairman Powell even pointed out yesterday, some of these factors, or a lot of these factors, are beyond the Fed's control to an extent. There are external forces, geopolitical forces, rising interest rates, which, the long-term interest rates, which are spiked after the Fed meeting or spiking again today, that as well presents another headwind. So, we still see that as the base case, but there's a lot right here in those things we talked about and listed off that have to at least go okay. They can't take a sharply negative turn over the coming months and still have the soft landing stay in place.
Peter and Young-Yu, I would love to get an answer for both of you on this. What is your top trade idea when you think about a higher for longer reality that we might have to really consider here? And Peter, I'll go to you first on this.
Sounds good. This is probably going to sound crazy, but I actually like commercial real estate. I think so much has been priced in on the rate side, and I think we're going to see this work from home dissipate. People are being pressured to work from office. A lot of people actually want to work from office again. I think people are tired of sitting in their basements or whatever room they've got set up. They want to be in office. The CEOs want them in office. So I think that's going to be the big surprise, is a rebound. And, if prices were where they were 2-3 years ago, I wouldn't be saying that. But that sector has come off so much. It's so unloved. So many people want to hate it that I think that's where we get the surprise. So kind of my, really high beta trade that I like is commercial real estate plays and REITs.
But Peter, when you're trying to identify, just to jump in here real quick, when you're trying to identify the most attractive positioned within commercial real estate, right? Because it's not really a blanket. There certainly is different when you take a look at the quality of the commercial real estate and some of those loans. What to you is best positioned at this point?
I actually say like New York City office, for example. I think that got beat up. I think I'm a little bit reluctant still on San Fran, maybe Chicago, where I think there's demographic trends that are pulling people away from that. But I want to be in places where everyone wrote off, hey, no one wants to work in the city. No one wants to be in offices anymore. That is changing. It's changing dramatically. Our own firm's now up to 4 days a week. And, I think a lot of firms are up to 5 days a week. That push is going to be really strong. There's this chance for, and again, like a lot of other things, a lot of these companies did a good job borrowing for long term. So they've locked in rates for a decent amount of time. There's time to restructure and work this out. So the absolute valuations are good. And, I maybe want to be a bit careful in some of the really hot regions, like the Floridas of the world, where maybe there is some overvaluation because everyone thought that trend would develop. And you're starting to hear more and more, especially after the weather we had this summer, people saying, hey, maybe the Northeast isn't so bad to live in.
It's not, in our biased opinion, very much so here in New York City, as you can see behind us. But, Young-Yu,
Mine too out of
as you
Connecticut.
think about, well, there you go. We're all proponents of it. Young-Yu also wanted to get your top trade idea in a higher for longer scenario.
We still like U.S. infrastructure here. We think that has a very long runway. The estimates of how much government spending and stimulus is actually going to go into that keep getting increased because A lot of that stimulus was structured as uncapped tax credits, and we think that has multi-year spending that a lot of trends work in their favor. So a lot goes into that. It's some segment of the industrial sector, some segment of materials. There's an ETF way to play that focuses on U.S. infrastructure, but we think that has a multi-year runway ahead of it and a lot of staying power, even with higher rates.
Peter Chur, Academy Securities Head of Macro Strategy, and Youngyu Ma, BMO Wealth Management U.S. Chief Investment Officer. Great to have you both here with us this morning. Appreciate the insights and the analysis here.
Thanks for having me.
Thanks, Brad. Thanks, Shauna.
Certainly. Well, as the weather gets colder, cases of COVID-19 are beginning to tick up again. According to the CDC, COVID-related hospitalizations are up 7.7% in the latest week of data. Now, the Biden administration is bringing back the free testing kits. Here with the details, we've got Yahoo Finance reporter Anjali Kamlani. Anjali, what do we know so far?
Well, Brad, we know that, of course, the government has announced yesterday that they're going to restart mailing free COVID tests to whoever signs up for them. And that starts on September 25th. And that is the fifth round of free tests that the government has decided to disperse in time for this winter wave. As you mentioned, we have already seen hospitalizations ticking up, some states more than others, Florida seeing quite an increase there. And we do know that, of course, the EG5 variant is the one that is currently dominating and causing these hospitalizations and some concerns. It now accounts for about 25% of cases. The government has also announced that they're going to be dispersing $600 million to fund this effort, and that includes a dozen companies that are going to be producing up to 200 million tests for the government to get added to their stockpile. So, while we are seeing this move, there has also been some concern about not enough being done to help with the coming wave. We know that the vaccine boosters have already been approved in most cases. We're still waiting on word from Novavax, but at least the two mRNA options are out there. There have been some struggles to gain access to those with the rollout, so that's a concern. Meanwhile, mask mandates, varying levels around the country. So it's a little bit of a mixed bag picture when it comes to how the country is responding to an anticipated increase, as we just saw at the tail end of the summer, a slight uptick in cases. Experts do anticipate that there will be a greater uptick through the winter months with these new variants.
Do we know anything about the severity of this strain? And when we talk about these shots being available, in terms of the uptake, because we heard some projections from Pfizer and Moderna earlier this week, what does that look like as we look ahead to the coming months?
Yeah, the severity is different. Of course, we have a slightly immune population, at least having some level of protection with vaccines or previous infection or a combination, and that provides a higher level. So most people are largely protected from severe cases. However, those that are most vulnerable do need to get those boosters in order to really increase, their protection levels against severity. But we are seeing those upticks in hospitalizations because there are still people who are not protected or whose protection has waned significantly over time. And so, to that question about the severity of the strain itself, we've definitely seen a shift in how COVID is presenting. Earlier on, fever used to be the one telltale sign, and that's not necessarily the case anymore. It has been a little bit less severe in terms of those symptoms, coughing, a little bit of a heavy chest, maybe a little bit of congestion. Those are some of the newer symptoms that are sort of the telltale sign now. I can tell you, having been in a household with people who just got it, so have a little bit of personal expertise there. But yes, to the point of, what will the demand be for these vaccines? That still remains to be seen, whether or not people are taking this rise in cases seriously, whether or not it is, significant enough, and whether or not other variants show up by the time the winter months come around, because we could still see a rise in something else until then.
Well, Anj, hopefully you were able to avoid it. It's tough to do if people within your own household have it, obviously, given the fact that it is so contagious. But Anj, as always, thanks so much for that update. All right, well, we've got all your market action ahead live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance.
decision to keep interest rates unchanged was widely expected.
We're here at the Nasdaq in New York City. Let's do a quick check of the market sponsored by Tasty Trade. And once again, we're looking at pressure across the board with all three of the major averages moving to the downside. You're looking at the Dow off now just about 75 points. The S&P off about 0.7%. The Nasdaq, though, off about 1%. A lot of the pressure that we're seeing in some of those larger cap tech names, also consumer discretionary, among the worst performers so far this morning. We've got our own very own Jared Blickery here with us now to break down some of these moves. And Jared, Amazon off just about 3%.
Yes, the screen doesn't look as bad as it did on the open there. And you can see Apple up 14 basis points, Microsoft up 43. But for the most part, everything else mired in the red. And I'll change this to a two-day view one more time so we can see the damage done since that FOMC decision announced yesterday and Chair Powell's comments yesterday as well. I think the message is higher for longer and a little bit higher than everybody thought, because let's take a look at the bond market. What's happening with the 10-year, very instructive. This is kind of telling you, no, we might have a repricing of risk even higher with respect to interest rates. You can see heading towards 4.5%. Last time we had a 4.5 handle, that was probably back in 2007. We're almost into 2006 territory. So really lots going on. I did have an interesting quote from someone over at Goldman Sachs, and I just want to read this. This will help give some color on what happened yesterday with respect to the FOMC decision, saying, I'd say overall, and this is Mike Cahill over at Goldman Sachs, I'd say overall, this is the FOMC not fully embracing the immaculate disinflation, creeping towards a higher neutral. Very much still a case where the Fed is not able to convincingly say it's done just yet, and more importantly, not able to say it will be easing anytime soon. And so I think this should make the dollar a hard bar to beat against its main rivals. So we have interest rates heading higher. We have the US dollar heading higher. And let me just show you a quick chart of the dollar as well here. This is going to be what over the last, we got to trim that down to a year to date, but you can see how it's been racing higher there. This acts as a headwind against a lot of asset classes, including multinationals, including commodities, but nevertheless, we've seen commodities surging higher in the face of the dollar. So all of this is just to say, this is giving the Fed an even tougher time for that next meeting. We're not even 24 hours away from the last one. I'm already thinking about the next one. That's where my head is. Here is the sector action for today. We're seeing energy, the only sector in the green, and that has been a stalwart over the last couple of weeks with those higher energy prices, but everything else in the red. Taking the rear is consumer discretionary, that's XLY, and then we have real estate, materials, and industrials. Those are rounding out the bottom few, and I'm just going to I'm going to show our leaders here. Been a while since I've seen all of our leaders in the red as well. Now, if we dig into some of the individual sectors, we'll see a little bit of a bifurcation. Microsoft making software not look too bad, but you put it on an equal weight basis, well, that's a lot more red than green. Similar situation for the semiconductors. Intel is in the green for about 0.2%, but Broadcom down 3.5%, SMCI, Supermicro down about 4.5%. And let's look at the energy sector. Let's leave this on a little bit of green. It looks like Marathon Petroleum up here, that's up about 2.5%, but kind of a mixed board. So even energy, the best sector of the day, still mixed here, guys.
All right, Jared, thanks so much for tracking all of this. Some really interesting moves, especially coming off of that Fed decision yesterday. Appreciate it.
Let's take a look at shares of Klaviyo. They are trading to the upside once again this morning, up just about 4%. Now, the marketing automation company saw shares open more than 20% higher during its market debut on Wednesday, following in the footsteps of recent IPOs from Arm and Instacart. Now, yesterday, I spoke with Klaviyo's co-founder and CEO, Andrew Bialecki, about the big debut. Let's take a listen to what he had to say.
At Klaviyo, we believe that every company should have smarter digital relationships with their customers. That's a super durable trend. We're a very long-term oriented company, and so that's one. And two is we just believe in being disciplined in how we grow. I think we believe in creativity, and the constraint that constraints really force creativity. So I mean that's what our company's all about: is aiming long and then just executing really well.
Turned profitable in the first half of the year, net income of just around $15 million. Are you confident you're going to be able to stay profitable?
We'll see. Won't look forward right now, but I mean, we've just that discipline in the way we think about building, getting close to customers, getting close to partners. I think that's how you build great businesses.
You founded Klaviyo just over 10 years ago, back in 2012. I'm curious, before we talk about your customers, from the targeting standpoint, when you take a look at the consumers out there, how have the consumers' needs evolved over the last 10 years?
Sure. Well, consumers definitely, they want the businesses that they work with. I mean, that they buy from, they transact with. They want those businesses to know who they are. I think we've all gotten messages or had these experiences where it felt totally unpersonalized, just generic. That should be better. And what we found is the businesses want to deliver that because they know customers love personalization, and that's what gets them to buy more. The tech was missing. So that's what we've been trying to build and what we've built. And I think a little bit of proof point. We've got everybody from entrepreneurs just starting out, small businesses, now moving up into the enterprise. I mean, we think there's a lot of customers out there that should be running on Klaviyo.
And I believe you do it through predictive models of consumer behavior, right? So how much of that are you relying on AI for that part of the technology?
Definitely. So machine learning, artificial intelligence has been core to our strategy, I mean, really for the last 5, 6, 7 years. I think if you look at a lot of, we'll just take marketing as a space, you have to be a really talented marketer, and you're still experimenting to figure things out. Every customer I talk to says, Andrew, what ideas do you have that I may be not thinking about? Well, the good news is you can use artificial intelligence to not only generate content, but help come up with those ideas. I think in the future, we're going to build software that is good at using itself. So in this case, the marketing software, literally, you plug your business into Klaviyo, it'll develop your marketing strategy, and if whatever your growth goals are, it'll build that optimal path to help you get there.
So should investors be thinking of Klaviyo almost as an AI play?
Yes, I mean, we think about it as we've built the data infrastructure to store all your data, the applications, the marketing software to connect with those customers, and then it's really artificial intelligence that brings it all together so that even if you're not a great marketer or you want more advice, you can get that automatically with our software.
And Andrew, your customer base right now, just over 130,000. When you take a look at that future growth, what do you think is going to drive that, and who are you targeting, where are you targeting?
Sure. We look to, honestly, we try to delight our customers, and then we know that they talk. Actually, a lot of businesses, you can grow virally. So we're going to continue to lean on that. We have wonderful partners. We're excited. We're getting, larger and larger brands are coming and saying, hey, I want to standardize on Klaviyo. We've opened offices in London and Sydney in the past few years. We're excited to expand globally. There's a lot to do.
Your international exposure right now, I believe as a percentage of your revenue, right around 30%, right around a third. What do you hope that looks like 5 to 10 years from now?
Yeah, I don't know. International is a really exciting market. I've spent a lot of time just traveling in Europe and in Asia, understanding how businesses there work, how often I'm surprised that they're just as driven as the companies that are maybe in our hometown of Boston. I don't know where that ends up, but I'll tell you there's a lot of growth there.
When you talk about some of your customers there, and I was going through your S1 filing, nearly 80% of your company's average annualized revenue coming from customers of Shopify. Some are saying that maybe that could be a potential risk here. What's your response to that?
Oh, we're not worried about the risk. I have known the Shopify team for a long time. We love working with market-leading platforms, and they're definitely a market leader. We're excited to work with more with Shopify and platforms in other verticals outside of retail and around the world.
Our thanks to Andrew Bialecki, the co-founder and CEO of Klaviyo. And again, Klaviyo, it's the second day of trading for that company. Shares up just about 3%. Well, we've got all your market action ahead live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance.
The writers and actors have been striking against Hollywood executives and studios for over 100 days. According to reports, meetings on Wednesday were attended by Disney CEO Bob Iger, Netflix co-CEO Ted Sarandos, and Comcast chairman Donna Langley. Both sides are expected to meet again today to continue those discussions, with sources telling CNBC's David Faber that the talks may be nearing the end now. Let's bring in Yahoo Finance's Akiko Fujita to give us some more details here. Hey, Akiko.
Hey there, Brad. Well, you talked about those four CEOs being in the room yesterday. They are expected to be back at the table today. That is certainly critical and points to potential movements on the front in terms of negotiations, partly because that hasn't happened until now. As you noted, CNBC now reporting that a deal is close and could potentially be finalized by the end of the day today. The two sides, though, releasing a rare joint statement late Wednesday saying the WGA and AMPTP met for bargaining today and will meet again tomorrow. Now, the key issues on the table still remain the same. We're talking about writers specifically seeking residuals that would be tied to the number of views their episodes get on a streaming service as opposed to the number of episodes. They're also seeking a mandatory minimum level for the number of writers that are in the room in TV. Of course, protection from content related to artificial intelligence certainly on the table as well. Now, they are still apart on these issues, but there's been a sense over the last several weeks that these two sides, at least the divide, is starting to narrow. For example, the studios have agreed to guarantee that writers will not lose out on credit or pay if they use artificial intelligence to help write their scripts. The studios have also proposed to allow showrunners to hire at least two writers per show, still different from what the WGA is asking for, but shows some movement there. And the studios have not budged on the issue of residuals, but they have agreed to at least share some viewership data with the union. Now, we're talking about potential movement here in negotiations because there is a renewed sense of urgency between these two sides, largely because October has for a while been seen as kind of an artificial deadline on the table. For one, the studios look at more than 140 days into this strike. This is kind of the time they have seen that writers have started to really feel the financial pain. They believe they have some leverage on that front. For the writers, at least behind the scenes, there has been pressure building on the WGA to come to an agreement by October. So this year is not a wash. And the fear is that if this goes past October, that this could be done in terms of content for the year. So we'll be watching any developments coming out of LA today. We do know that both sides are meeting again. Will there be a deal at the end of the day? Still to be determined. We'll be watching that one closely, guys.
We certainly will. All right, Akiko, thanks. Well, the United Auto Workers strike entering its sixth day with no real progress in negotiations. Now, the union saying that Stellantis' new contract offer lacks job security guarantees. And General Motors, as well as the other big three, really pushing back. We had GM CEO Mary Barra on Tuesday saying that the proposed salary demands made by the UAW were too costly. Now, both Stellantis and General Motors are set to lay off workers, citing that the strikes are a cause of this. Now, with the president of the UAW, Shawn Fain, saying that strikes may expand tomorrow if we don't see significant progress. Joining us now, we want to bring in John Nichols, national affairs correspondent at The Nation. John, it's good to see you here. So some pushback from both sides. It still seems like the union and the big three Detroit automakers are very far apart on these talks, with the threat that the strike may expand tomorrow. How likely is that?
I think it's very likely. I don't expect that they'll have an agreement by tomorrow. I did note in the Stellantis statement and some of the other talk about the negotiations with Stellantis that there does seem to be some movement there. And there certainly are counteroffers going back and forth. So these are real negotiations. And I think that it is within the realm of reason that you can get a settlement not in the too distant future, but by Friday. I doubt that very much. So I do expect that UAW President Shawn Fain will expand the number of plants that are striking.
Is it clear whether or not there are any concessions that are beginning to make themselves apparent as part of the negotiations?
Yeah, I mean, on both sides, I think you've seen some progress. The talk is that the companies in their counteroffers have upped some of their financial offers. The union has been flexible on some of this. Yes, they made a very, very big ask. I think understanding that they would step back from that to some extent. So I do think there's elements of movement, but there's still this real problem. And this goes beyond the finance. So much of the focus on this strike has been on the financials, on the ask for a big pay hike, the ask for a return or restoration of cost of living increases. But the other side of this is long-term job security and what will be done as electric vehicles are introduced to a much greater extent. Will those electric vehicles be built in union plants? Or will they be built in the north? Will they, there's all sorts of complex questions related to that. Even questions about battery production, how that will be done and who it will be done by. And all of that sort of floats behind any wage discussion. And I think those are some of the really tough areas to resolve.
John, when it comes to some of those sticking points and sticking with what you were just saying about EVs, given the fact that, yes, it's only been 6 days, but like you said, there does seem a high probability that we could see an expansion of the strike tomorrow. Is that going to delay EV manufacturing and the role that these big three Detroit automakers play within that space? Or how long, I guess, does the strike need to go on for in order to see that material impact?
That is a very good question, because you're focusing on exactly the area where I think everybody is concerned. It is this EV production, because of course you have Tesla and you have other companies that are getting rapidly into EV, and kind of every week and month that passes, that's a concern for the big three. That actually puts a little pressure on them to try and find some sort of solution to this. But it is also a complexity, because the making an electric vehicle requires a very different sort of assembly line, a different kind of work. usually requires fewer people, or potentially could require fewer people, and that's where the real deep struggle is here. And I do think that, it's funny that we just had a good discussion, or interestingly, we just had a good discussion about the writers' strike. The writers' strike dealing with AI, with new technology. There's a lot of that underpinning the UAW strike as well. And this question of, as the industry shifts, will it have a place for the number of workers and for workers in traditional industrial towns that have been there up to this point? That has not been really resolved at this point, and that's a big deal in this strike. It's a pressure on the companies because they want to be in the midst of this EV rollout, and they want to be flexible, but they definitely don't want to be, fall back as production goes. But it's also something that for the workers is a huge deal. You have to understand that when you have negotiations of this kind, workers want to be at the table determining, or at least having a role in deciding how new technologies are applied and how they affect the industry. As in the writers' strike, so in the UAW strike, that's a big factor. And it's what kind of keeps these two sides wrestling and I think struggling to a large extent.
When we think kind of broad head count for the UAW and the amount of members that they represent, does the prospect of augmented intelligence or even more robotics within that daily manufacturing operation drastically reduce the amount of headcount that's necessary? And if so, how does that enable some of the auto manufacturers to say, okay, well, all in, we could be looking at roughly some of the same costs if we're looking at a lower base, and then at the same time still able to produce the same amount of vehicles?
Sure, this is getting into the heart of the matter, because when you move to these new types of production, the worker that comes into the plant may be dramatically more productive, literally helping to produce a lot more vehicles, but that individual worker can do it perhaps, on their, as an individual rather than as part of a group. So you're reducing the numbers. What the union has said is, look, there's a lot of things that you can do to address this. One is to go to the 32-hour week. And the 32-hour week allows for workers who are more productive to be paid at the rate they've traditionally been paid, but for a fewer number of hours. That keeps more workers in the plant. That's something that's a big priority for these folks. Another thing is the discussion about all of the parts and ancillary activities that relate to the electric vehicle. Who's going to be making the batteries? Where are they going to be made? There's a lot of work to be done in the electric vehicle rollout, and there's enough work for a lot of UAW members. It's just a question, and part of these negotiations, of will that be done by UAW members, or is the company really looking for ways to offshore or at least to move to other places and not have UAW members in the game? That's what the union's very concerned about, and that's absolutely their responsibility. They represent hundreds of thousands of workers, and they want to make sure that those workers have a future, have something to do going forward. This is a question not just for the auto industry, but for industry in general. It's something that as a country we have to wrestle with as regards AI technologies, as regards automation, robotification. All of these factors are real tests for existing industries and frankly for the industries that come in the future.
John, certainly appreciate you sharing some of your research and insights around this. Nation Magazine National Affairs correspondent John Nichols, thanks for the time.
It's an honor to be with you.
Thanks. Well, all your markets action straight ahead live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance.
Shares of KB Home lower today, off just about 3.5%, despite beating Wall Street's estimates for the third quarter. Now the stock falling after the home builder reported a drop in homes delivered and average selling prices during its latest quarter. Our next guest, though, despite all that, still says that KB Home is well positioned. So let's talk about that call. We want to bring in Buck Horn. He's an analyst with Raymond James. Buck, it's good to see you. So despite some of the concern that we're seeing, especially amongst investors here this morning, you still have an outperform rating on the stock. You're still pretty positive about what you're expecting to see from KB Home. Why?
Yeah, no, it's a good question. And obviously the concern right now is that higher mortgage rates are going to continue to crimp demand. And there's no question that, higher rates for housing is generally not a good thing. But I think there's a couple things going on in the new home market, which I think investors need to consider. Well, and first and foremost, you have to consider the valuation of the stock. We find KB Home now trading basically through its tangible book value, despite consistent profitability, a fantastic balance sheet, and looks like consistent growth and stable margins going into 2024. So it's already through its historical cyclical lows at these valuation levels. But what's going on in the new home market in particular is the inventory availability, that they're continuing to keep production going. They offer financial incentives for their buyers to get in, at somewhat below market rate mortgage rates. And also, they're adjusting price and they're adjusting floor plans to figure out how to make it more affordable for buyers. And with that, what they're also attracting is a much higher income household into their new home communities. I think that's often overlooked, is that, as the existing home market, the lock-in effect effectively, and continues to take inventory out of the existing home market, those higher income buyers that, where life happens and they need to get into a house fairly quickly, they're migrating into new home communities. And KB's average household income is now up to $130,000, extraordinarily high FICO scores, average down payment 15%. And those buyers in the new home market in KB communities can afford a new home at 7.25% mortgage rates. The math actually still works for those buyers.
And so, Buck, when we think about the home cancellation rates that we've seen, home purchase agreements that were canceled in August, according to data from Redfin, 60,000 of them were canceled. So that represents about 1 in 7 pending sales for the month. How does that overflow into what we're seeing, or how does that give you a better read through to some of the home builders, especially the KBs, the Lennars, the Toll Brothers out there?
Yeah, I mean, anytime you have mortgage rate volatility and rates are rising, it's going to push some buyers to get either cold feet, or it's going to create some qualification issues. And usually those are temporary. But generally, as we've seen the year progress, buyers have been adjusting to these higher rates. We haven't seen quite the level of volatility that we saw late last year. But we are seeing, cancellation rates in the new home market are performing better. Can rates were down for KB Home, both sequentially and year over year. So buyers that are still in the market, those that are in the new home market are committed. They need a house. Life is going on, and they are financially capable of adjusting. And of course, there's also an advantage in the new home market where if rates are volatile, the builder can step in and in some cases offer, additional incentives, additional mortgage rate buy down to make sure the deal closes. But for the most part right now, we're seeing that they're not having to do that. In fact, KB was able to raise prices in 65% of its communities just this past quarter, and still seeing steady demand through the end of August. So that still gives us a good indication that, people are concerned about rates, but for the most part, they're able to adjust and afford these higher monthly payments.
Look, do you think that that's something that's going to remain the case? Because we heard from Chair Powell again yesterday warning about this higher for longer environment. So if we don't see any real move lower in mortgage rates, if it hovers around 7%, I guess, at what point do you see this maybe potentially being a bigger headwind for the home builders in terms of demand?
I mean, you would have thought by now it would have happened, right? But everything we thought we knew about the housing market entering 2023 is basically upside down. Basically what's happening is as rates are going higher, the available supply of inventory is shrinking faster than the pool of demand. The buyer pool is falling off. And a lot of that just has to do with the demographics and just how deeply undersupplied single-family housing is across the country after almost 15 years of underproduction of this particular product type. So, short answer is I don't know. Obviously higher rates are not good for housing. It will slow demand. There's no question, but the new home market is behaving very differently than the existing home market. And investors need to bifurcate that in their mindset, because the new home market is still actually doing quite okay. I mean, it certainly could be doing better with low rates, but the builders, because they can keep production going, because they can keep, the incentives flowing, they're doing fine, and they're extraordinarily profitable. They're throwing off tremendous amounts of cash flow, and they're buying back their shares at tremendous valuations, which is generating significant earnings accretion. So again, that's part of the game plan. But at some point rates will slow down housing demand, but the new home market seems to be going on, steady as she goes.
All right, Buckhorn, Raymond James analyst, joining us here today. Buck, thanks so much for the time.
Thank you.
All right, all your markets action straight ahead, live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance. Some hot news hitting McDonald's this month for a limited time. McDonald's is bringing back their spicy chicken nuggets. The wildly popular nuggets are coated with aged cayenne and chili pepper. They made their debut back in 2020 and return annually in select locations here. Okay, so I'm not the connoisseur of chicken nuggets as some in our office are. However, this is a big deal. I actually questioned ChatGPT who has the best chicken nuggets as of right now. The rankings came in at McDonald's #1, Chick-fil-A #2, Wendy's, ticker symbol and WEN #3, and then also you got Tyson in there. That's also one of the popular ticker symbols for chicken nuggets on the Yahoo Finance platform.
You know, I had no idea how popular these were. I didn't know, obviously. Actually, when I think of chicken nuggets, I think of McDonald's. I never knew that they had this spicy nugget option. Apparently, they've been offering it for the past couple of years for a limited time. People are obsessed with this. One person saying that this has dramatically improved my day. This is the best news I've heard all year. I cannot wait. Going right now. I mean, the commentary that we're getting from this Instagram post is incredible. And I just think it speaks to one, we all got to try it, obviously. Alex, I know Val, our head of live, is a huge fan of chicken nuggets. So she's got to get us the spicy. We're going to put it to the test. But two, McDonald's is so smart with this.
They are, yeah.
Their limited menu, it gets people excited, and it gets them to spend more every time.
It's been a huge year for McDonald's.
Spend more.
I know, and you know, at the end of the day, when people think about what's going to make you happy with your food purchase, sure, nuggets make it into the realm, but it's also just a strategy and how McDonald's has been able to just drive this kind of experiential food happiness, and it's been very strategic. We talked with the CMO, Tarek Hassan, in Cannes Lion Film Festival, or Festival of Creativity, I should say, just about all of these different campaigns, whether it's been annexed to some high-profile celebrity, or whether it's involved a purple taste bud by the name of Grimace, or whether that's making sure that they've just got a good, flashy food item that's going to drive even more traffic, like a spicy chicken nugget. Move over chicken sandwich wars. The chicken nuggets wars are back and hotter than ever, apparently, with this new spicy nugget.
They always are. And the fried chicken sandwich wars, that's another one.
Yeah,
It always heats up every single year. Maybe we'll get a Boo Bucket again this year from McDonald's.
What is a Boo Bucket?
A Boo Bucket? They have a limited
Is that Valentine's
time.
Day thing?
Yeah, but a Boo. Oh, well, you're thinking like, oh, you're cute. No, like Boo, like scary, Halloween.
Oh,
They have it in
okay.
October. So maybe we're going to get that again
Different
this
booze.
year. A different boo. All right, guys, let's do a quick check of the markets. We're getting 90 minutes into the trading day, and we're still looking at losses across the board. Dow off just about 168 points. The Nasdaq, the biggest decliner of the three, at least right now, off just about 1%. Keep it right here. That's all for us today from the Nasdaq market site in Times Square. But Yahoo Finance continues on the other side. See you tomorrow.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. Higher for longer is the name of the game, it seems. Fed Chair Jerome Powell making clear the central bank is almost done raising rates. The Bank of England also making waves by leaving borrowing costs on hold. We're across all that action for you this morning. And no breakthrough yet for the UAW and Detroit's Big Three ahead of Friday's deadline. Stellantis has come to the table with a new contract proposal, but there's no green light yet. We get you one journalist's inside scoop on this issue. Plus, Elon Musk's biotech startup Neuralink is recruiting for its first human clinical trials. But can the billionaire's controversial company really connect the human brain to a computer? We'll have those details just ahead. But first, let's check in on the major indices this morning. Looking at some selling action here, the Dow here currently off more than 180 points, down about 0.5%. S&P 500, they're also down just over 1%. Similar story for the tech-heavy Nasdaq, bearing the brunt of the losses so far this morning, down 152 points, seeing some volatility in light of the hawkish tone that we heard from the Fed, even though they are keeping rates steady, at least for now, with the potential for a rate hike at the end of the year. Let's also check in on the Treasury market, see how that's been impacted. We see the 5-year, the shortest term yield, they're up over 2% on the day. The 10-year, as you can see, they're rising 2.87% there, currently at 4.47, and the 30-year also up about 3% on the day. Well, the FOMC isn't the only central bank making moves this week. Several central banks issued interest rate decisions this morning. Joining us now with the latest is Yahoo Finance reporter Inez Ferre. Hey, Inez.
Hey, Rochelle. Well, let's start with the Bank of England. In a 5-4 vote, the BOE voted to keep interest rates unchanged and not to hike today. This is a significant decision because it was a very narrow vote, and 4 committee members wanted to hike by another 25 basis points. Now, the UK has had some very aggressive a slowdown with inflation. Part of the decision why the rates were kept unchanged is because of the slowdown with inflation. And the UK has had a lot of inflation, higher than other European countries, and it's been sticky inflations. Now, the Bank of England has been increasing rates aggressively since December of 2021. So a significant decision to keep those rates unchanged. Meanwhile, the Swiss National Bank also left its rates unchanged, ending a streak of 5 consecutive increases. Other European countries opted for rate hikes, with Sweden's central bank raising its rates to 4%, in line with what economists had been expecting. The Scandinavian country has seen its currency slide against the euro in the last couple of months, and central bank officials said inflationary pressures in Sweden are still too high. Now, Norway raised its rates by 25 basis points, leaving the door open for another rate hike this year. Meanwhile, Hong Kong's monetary authority decided to leave its rates unchanged in lockstep with the U.S. Now, Hong Kong's currency is pegged to the U.S. dollar, so it follows the Fed's lead closely. And it's important really to note that some countries have moved in tandem with the Federal Reserve to combat inflation and also to protect their own currencies. Higher rates in the U.S. tend to make the U.S. dollar stronger. Now, the question as we approach the last quarter of 2023 is, are the rate hikes over or pretty much over? And will the Fed and others be cutting rates next year? Now, there was a recent poll done by Reuters that shows that nearly 20% of economists expect that one more rate increase this year in the U.S. And of those polled, a majority saw rate cuts sometime next year, likely in the April to June period, no earlier than that. Rochelle.
Interesting to see how different central banks are approaching this. Obviously, have their own internal issues as well, but interesting to see how they're not quite in lockstep at the moment. Big thank you there to our very own Inez Ferre.
Thank you.
Well, the Federal Reserve decided to hold rates steady at yesterday's meeting, making it clear the central bank is almost done raising rates. But with inflation still sticky, next year could see fewer cuts than previously indicated. Our next guest says the Fed is far from mission accomplished, and the market consensus is expecting too many rate cuts. Joining us now is Keith Lerner, Truist Chief Market Strategist. Good to have you back on the show here, Keith. So in terms of what we thought was going to happen, in terms of pricing and what some of the markets clearly thought were going to be some cuts we were going to see this year, now those projections being pushed out to 2024. How is the sentiment here? How accurate are the markets getting this story right now?
Yeah, well, great to be with you, Rochelle. Wish we had a better day as far as markets, because we are under pressure today. And I think the market is taking this as a negative. And I think, our view for some time for this year is that this inflation battle of the last year has caused a shift in the reaction function from the Fed. They have scar tissue, meaning, this is the first time they've had to deal with inflation for over 20 years, and that they're going to be much more gradual in shifting their position. And we saw that reflected in the statement yesterday. And I think really the key today, when we have these Fed meetings, what I really look at is how's the market reacted? And I will say really what's pressuring markets more than anything today, to me, is the risk-free rate. The 10-year Treasury just broke out of the range that it's been in for several months and above the highs from last October. And I think that's why you're seeing pressure across the capital markets today.
So then, as you look at what's happening with yields, what is that signaling about some of the sectors that perhaps could be leading the way and how people are trying to really play this period right now?
Yeah, I think one thing that, what's a challenge right now is there's no sector leadership. Energy had been the sector leadership, and I still think that looks relatively attractive, but that's even giving it back. So at this point, we're waiting for the real sector leadership to stand up. But I will say the way we've been thinking about this is you want to stay away or have less exposure to more of the interest rate sensitive areas of the market. So what do I mean by that? Well, one, think about small caps. They're really cheap. However, they have about 3 times the floating rate debt relative to large caps. And what are we seeing today? Small caps breaking down. Real estate, as we have more of that refinancing happening, they're going to be impacted by higher for longer as well. So you want to kind of stay away from some of those areas. And then, as I mentioned, we're still waiting for the new leadership to emerge. But in the interim, we still like areas like communication services. We still like industrials. But it's a really mixed overall market right now. And I think we're in this seasonal weak period where I think we have more of this choppy waters to go.
So Keith, I was going to ask you, in terms of the choppiness, is that something to expect as we stay higher for longer, or are we going to be really bracing for a correction at some point?
Well, I think in some ways, when you think about a correction, it can happen in 2 ways. One in price, so we're starting to see some of that, and also in time. It just means markets chop around, let the fundamentals catch up. And I think we have more probably on both sides. And we all know we're in this seasonal weak period. And seasonal, sometimes they work well and sometimes they haven't. This year, the seasonal trends work pretty well. In our view, you probably need to get through September, probably a little bit deeper correction and more of this time correction to set up for a better potential of a fourth quarter rally, because we don't have sentiment. It's not washed out yet. And, we don't have, as we look at it, there's not a lot of near-term obvious upside catalysts, right? We're still talking about the UAW, government shutdown, and we still have to wait for earnings. I think that as we get to the earnings season, that might be a more positive period. But between now and then, there's a dearth of, again, obvious upside catalysts for the market.
So then how do you position yourself if you're not sure just how choppy it's going to get? Obviously, a lot of time between now and a potential, next rate hike from the Fed coming in November. What are some of the questions that your clients have about how to allocate their portfolios?
One thing we try to remind folks, we're not just investing for the next, month or 2 months. Our tactical time horizon is at least 6 months to 18 months. And, big picture, with all these cross currents that we're seeing right now, our view is strongly neutral, which is an opinion. People say you're neutral, you don't have an opinion. We have an opinion. We think that you should be more kind of closely aligned with your long-term targets. This isn't a time to take big, bets, with stocks versus bonds versus cash. So kind of keep that in line with long-term targets. But where we are focusing is, as I mentioned, U.S. over international. Coming into the year and still today, one of our biggest bets was U.S. large caps, where we had a big overweight and underweight emerging markets. There's a big spread there. We still think that makes sense today. And then, as I also mentioned, be higher up in market cap. Have these companies that can kind of get through these cross currents. So again, large caps over small caps, and be wary of some of these areas of the market that are more, susceptible to higher rates.
And Keith, we are seeing some of those concerns making their way through the markets today. I mean, if you look at the VIX, currently above 16 at the moment versus where it has been, where we were sort of in this lulled period where it seems like markets were not taking the risks seriously enough. But when you look at the cacophony of risks, I mean, as you mentioned there, you have the UAW strike, also a potential looming government shutdown as well. So when you put that picture together then, what do you think are going to be the key risks that investors should be really keeping a mind on for the next few months?
Yeah, well, listen, I do think some of those risks are there. I mean, the government shutdown, we've done a study on this recently. Normally, it provides a lot of angst and maybe a short-term disruption, but during the historical government shutdowns, we've had 20 of them. During the actual government shutdown, the average return is 0.0, which means they don't tend to have a lasting impact. But listen, a headline, that's a risk. I also think we need a 10-year to settle down for equity investors to feel comfortable stepping in. So I think really keeping an eye on the 10-year Treasury itself and these inflation reports that we're going to get. I know we'll have one next week, and then the employment report will be important as well. But I also think, I think context is important. Historically, on average, we get about 3 pullbacks of 5% or more per year. What's consistent about all those, they all come with bad news. This year, we've only had 1 pullback. That was early in the year. So at this point, the underlying trend is still positive for the market. We have to work through this kind of consolidation, this choppy period. And I would say the main level for the S&P 500 is around that 4,200 level. As long as we're above that, you have to give the benefit of the doubt to the upside. I'm sorry, to the uptrend of the market. But markets tend to move in 2 steps forward, 1 step back. And right now we have 1 step back in our view.
I appreciate you joining us with your insights. Keith Lerner there, Truist Chief Market Strategist. Thank you for your time today.
Thanks, Rochelle.
All right, well, I have my eyes on ARM shares today, falling below its $51 IPO price. As you can see there, it's currently at about $60 at the moment, though. Now, it's been a week since the British chip designer debuted on the stock market. The stock originally soared 25% as investors rejoiced over the return of the IPO market, but it has been under pressure since. And ARM isn't the only recent public offering that's been under pressure. Instacart also hovering just around its IPO price after that initial boost, while Mediterranean fast casual restaurant Carver and direct-to-consumer beauty company Oddity Tech have both fallen below their initial trading price. All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Have you tried pickleball yet?
Not only have I played pickleball, I have a combination of 8 rackets in 2 locations.
Oh my gosh. Okay, so you got like one of the racket bags. You're official now too.
I have a racket bag that I carry multiple rackets, and let's just say, Brad, that I bring my balls.
All right, sign that man up for the majors for sure.
Let's do a check of the market sponsored by Tasty Trade. Continuing to see that selling action picking up. The Dow currently off more than 200 points there, or about 0.6%. The S&P 500 there also down by about 50 points. They're down about 1% on the day. All 11 S&P sectors in the red. Consumer discretionary, the biggest laggard. And the tech-heavy Nasdaq there also down about 165 points, or 1.25%. Well, the Federal Reserve paused interest rate hikes this week, yet home buyers remained sidelined by the elevated cost of borrowing. Yahoo Finance's Danny Romero joins us with more on what buyers and sellers are up against. Hey, Danny.
Hi there, Rochelle. Homebuyers like stability, and the fact that the Fed put a pause on rate hikes really gives little relief to a challenging housing market. And while the Fed's decision can make a next day jolt in interest rates, the cumulative effect really will take some time to play out. So with that in mind, enough economic downturn could lead to rate cuts, and homebuyers could take advantage of that. There's a recent survey from Realtor.com that shows that 36% of homebuyers said that a recession would make them likely to buy a home. And the share was even larger for first-time homebuyers. So rate cuts could also be advantageous when it comes to increasing the inventory out there and prompt some homeowners to sell, which are really reluctant right now. So what does this all mean, Rochelle? Well, homebuyers and homeowners may be tempted right now to really follow and mirror the Fed's attitude of a wait and see.
Well, now, Danny, U.S. existing home sales data was also released today. Now, the National Association of Realtors finding that previously owned homes sold in the U.S. dropped by 21% in the last year. Can you tell us more about what this is signaling?
Rochelle, in one line, this was a really grim data point, and multiple economists on the street say that the worst is to come, and that really says a lot. And this also signals that the rising mortgage rates is really pushing homeowners to the sideline, including homebuyers as well. The fact that there's not much inventory out there for them to scoop up. And while the Fed's, meeting yesterday really gave some clues, there is another rate hike on the table for this year, so suggesting that rates will hold steady and higher for longer. One economist said that from the National Association of Realtors says that mortgage rates could even hit 8%, hindering that purchasing power. But today we're going to see where mortgage rates land this week. That's coming out at noon today. Rochelle.
I mean, it's tough. I mean, obviously, mortgage rates had been historically low, but the timing of this certainly very difficult, especially given the low inventory as well. Appreciate you getting us up to speed. Yahoo Finance reporter Danny Romero. LimeWire, the website where we all didn't illegally download music from the 2000s, is making a comeback. They're moving into the AI photo generation space by acquiring Blue Willow, one of the largest AI photo generation communities. To talk about moving into the creator economy and AI is Marcus Feistel, LimeWire COO. Good to have you on this show here. So obviously a lot of us saw all these different sort of AI challenges where you could see what you look like when you're sort of revamped in these different images and things. Talk about how LimeWire has gone from just being a file sharing peer-to-peer community to now incorporating AI into the space.
Yeah, happy to. First of all, thanks for having me today. So really pleasure to be here. Yeah, so LimeWire has been revived. We relaunched the platform last year already, and it's really our aim to become the #1 platform for anybody who wants to become a content creator or is a content creator to create their content, make it public, and also monetize the content. That's really our main aim. We started with a lot of Web3 capabilities, including an NFT marketplace for every creator to own their assets and their fans to also own a share of it. And now we're tapping into the AI space, pretty much enabling anyone to become a creator. It's really one of the key parts in our tool set to enable anyone to create their first content pieces and start their entrepreneurial journey as a creator.
And Marcus, I mean, there was this huge rush when generative AI was, first came into the fray, and a lot of companies popped up, doing similar things. What is going to be the differentiator for LimeWire?
So what we've seen, and I think that's exactly like one of the key issues with a lot of technologies that are being invented in the past years and decades, we've seen that there's a lot of very cool technology out there which is solving a lot of problems, but without the interface to make it really mainstream and to allow anybody to access it. And that's exactly where we come into place and where we see our strength. I think Blue Willow is a very good example of a pretty huge, more than 2 million people creator economy, which has joined their community already. But they are lacking the tool set, like a nice interface to actually make that tool set accessible to anyone. And that's exactly where LimeWire comes in. We have an AI creator studio where everybody can start their journey of creating content with image generation. That's what we started to do now, and other content types coming soon. And that's exactly where we see the benefit of those two communities coming together.
And Marcus, I have to ask you about regulation in this space. Obviously, we've seen with the lawsuit that came from a group of authors, including John Grisham, George R.R. Martin, really concerned about some of their work perhaps being sourced and that AI is using it for those new creations then. What are some of the safeguards that LimeWire has to really protect original creators and how some of this data is being sourced?
Yeah, so I think one of the key issues is really data the model uses to train that model to pretty much get to these astonishing results. With Blue Willow, and that was one of the key factors in the due diligence process, we ensured that the data they used is definitely data that they hold the rights to, that they can actually use to train their model. For other models, we do a very diligent process and also reviewing what these models do, where they've been built. We have a couple of other AI models available on our AI studio as well, where you can also switch between models and see what the different results are actually giving you. And we always curate them very diligently. So I fully agree. It's a very key topic in the creator space, especially the rights holding. But we also know the past of LimeWire. So we are very diligent in the process of selecting our partners for sure.
So Marcus, with that in mind, what does the future hold from here? I mean, once we get everyone gets on board with, AI generated images, what is the next step? What does the next iteration of where this goes from here look like?
So I think this is really the first key step of enabling anyone coming to the platform who doesn't have the experience of being a creator or how to create content to really make the first steps into that space. So you can now come to LimeWire, use the AI studio, generate your content, publish it on the same platform, and then also start monetizing. We have a couple of features on the platform you can start earning with the content you created. So it's a really nice space for anybody who is a creative mind, but doesn't have the experience or tools at hand to actually start generating content. What we want to do in the future is make that content agnostic. So it's really about not only creating images, but we're also working on solutions for music, obviously. That's where the LimeWire brand is very, very associated with that industry. And there's a lot more to come in the future. We are onboarding thousands and thousands of creators. Just with that acquisition of Blue Willow, more than 2 million creators are coming to the platform. So I'm really excited about providing them with the tools they need to create their content.
I'll be excited to see where this all goes. Appreciate you taking the time to join us this morning. Marcus Feistel, COO of LimeWire, thank you so much.
Thanks for having me.
All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance. Goldman Sachs analysts and top executives from across the technology, media, and telecoms landscape are gathered in San Francisco for its annual Communacopia and Technology Conference.
Nextdoor is doing some pretty cool things on the AI front with our assistant and also with Vitality. For us, it actually starts to unleash unique data. We are the local knowledge graph, so I think the value of what we do starts to really shine forth. We're the only platform where you're finding out what's going on around you locally in real time. So with that data, we can do things like on the platform, help a neighbor compose a post in a way that is more engaging. So the assistant or the AI actually does that for you.
There's lots of interesting discussion we can have around AI. So we announced just this morning Zoom AI Companion, which is our answer to how generative AI is going to be included in our platform. And there's all kinds of really cool features that come with that for our paid subscribers. There are things like Chat Compose, if you're in a chat thread and you want to be able to respond to that. There are things like meeting summaries, which after the fact help categorize and capture not only what happened in the meeting, but also the true sentiment.
I think any creative would admit that AI is transformative to how they think about and how they concept new ideas. So I think it's going to be very exciting. It's still early innings, and we got to figure out how to do it right.
There's a lot of hype in our industry. I think this may be underhyped.
I think it impacts things at so many levels. It impacts how we interact with computers and how they seem personal. It generates how art and media is created. It's really a breakthrough in computer science, and it impacts not only the products, but it impacts how software is created.
There certainly needs to be a lot of debate about AI and journalism. 57% of newsroom jobs in the United States have been lost. We're facing another wave, in this case a tsunami potentially of job losses because of the impact of AI. And these are not just jobs lost, but it's inside lost. It's important that all media companies understand the impact, but it's incumbent on the big AI players to understand their impact.
We launched Intuit Assist. And Intuit Assist is really a personalized, intelligent assistant in your pocket. It's also powered by AI-driven human experts so that when you are getting assistance from Intuit Assist, if you ever need to talk to an expert, no matter what it is that you're doing, you're able to do that. So there's always a gateway to help.
AI is going to change this whole industry completely. And so we're thinking a lot about how do we use AI to match people a lot better, and to support the conversations that are happening. I think conversational AI is also a big opportunity because people do produce all these messages. So helping them craft those messages, make it easier to communicate, I think is something people will really appreciate as well.
This has been a big week in the IPO world, with Instacart and Klaviyo debuting. And last week, investors were more than pleased with Arm's listing. But it's been a bit rocky since then. So it begs the question, when does the next big IPO happen? Yahoo Finance's interactive wizard, Jared Blickery, is here to tell us more. Hey, Jared.
Hey, Rochelle. Let's take a look at some of the IPOs that just listed, and then we'll get into some of the future ones here, along with some interesting stats. Now, ARM Holdings just came to market, and let's check out the price action. You can see it's sunk below its IPO price. Not only that, but its first day trading price, it's down about 20% since last week. Now, Instacart, kind of a similar story here. You can see down 10%, and that is over the last few days. Kava Group, that listed a few months ago, and you can see back in early July, it is now sunk below its price. And now Savers Value Village, guess what? I'm not going to repeat myself here, but I don't have to with Kodiak Gas Services. Not surprisingly, energy has been one of the top performing sectors of the year, and we see this is actually holding on to some gains. And then let's hit Klaviyo, which just listed yesterday, change this to a two-day view, and you can see almost about break even right there. And this all highlights something that's really kind of endemic to IPOs, which is there's no rush to get in. And in fact, I've conducted webinars with Kathy Donnelly, who is one of the authors of a book, The Life Cycle Trade. 91% of companies undercut their first day trading price, and that's usually within the first year. So there's no rush to get in. You can observe the price action for a few months. If you really like the company, maybe then buy. There are some examples in history where that did not work out well. They just took off from their IPO day and never looked back. Alphabet is one of those names. So yeah, it would have been nice to get into Alphabet on day one, but lots and lots of opportunities over the last 20 years to do precisely that. This is a very hectic time of year, potentially. I've been talking about the VIX and how it tends to rise this time of year. So we could see a few hiccups, but it's really nice to see the capital markets opening back up again. I've been down to the Nasdaq. Well, I go to the Nasdaq and the New York Stock Exchange every day, and there's a bit more of a buzz, some chatter about what's coming down the pipeline. In that regard, we got some of the big ones out of the way with ARM and Kava and some of the others, but let's take a look at what's coming up here. And in that regard, we have Stripe. That's going to be one of the biggest of these theory. Then we got Birkenstock, and then Kindly MD. So you put it all together, it's nice to see these things coming to market, but we probably have a little bit to go before the capital markets completely thaw, and it's kind of the green light for companies to jump back in the pool here.
And certainly seeing a lot of variety in the different sectors. I mean, you've got Birkenstock there, you know, ARM, a lot of different companies there for us to gauge this sentiment.
You bet.
Appreciate that, Jared. Thanks so much. Right, well, James Bond may have had a flying car, but the next big thing might actually be a 3D printed car. Now, automakers have been slowing innovating throughout the years, but the past couple of years has seen a large spike in car evolution between electric vehicle technology and new car design. Let's bring in Yahoo Finance's Praz Subramanian to tell us more about it. Praz, what are you watching?
Hey, Rochelle. So, there's an innovative new company out in California called Zinger. And what they do is they've been making this 21C supercar from their factory in Torrance, California. It's been breaking all kinds of records across the globe in terms of racetracks. But what it has is an innovative sort of secret feature here. I shouldn't say secret. What basically is that this car uses a bunch of 3D manufactured parts, as well as additive manufacturing, which means they take lasers and metal dust to create metal parts. So yesterday I had the chance to catch up with Zinger CEO Kevin Zinger, who founded the company as well, and he spoke to me about this process and how it works with this car.
What happens is that the machine, using AI, within the space within which we direct it to design, generates a design that meets all of the crash and durability and other requirements, splits that from a design standpoint into assemblable Lego blocks, 3D prints those Lego blocks in materials that we've created that are for each different purpose in the vehicle, and then there's something that looks like a robotic octopus that grabs those parts and puts them together.
So you mentioned that robotic octopus. I saw that actually in their factory in Torrance, and basically it puts together that jet fighter-esque looking car, that C21 that you see behind us there. It has this sloping roof, a number of parts inside and out, specifically in the rear of the car with the rear subframe and also some of the suspension components. I spoke to Lucas Zinger, who's, by the way, Kevin's son, who's the CEO of the company, and he showed me a few of those parts in the back of that car.
This is actually a novel 3D printed aluminum. So we're a materials company, we're an additive manufacturing company, and we're actually an assembly company as well. So this rear frame right here actually represents generative design, AI-driven generative design, novel aluminum alloys, 3D printing, and fixtureless assembly. So just this area of the vehicle probably represents about 450 patents. The system overall has about 650 patents on it now.
So the company uses AI in addition to this additive manufacturing and 3D printing process to create the best part, the lightest weight part, the strongest part for a given condition. So that's sort of the secret sauce here. But the big part for this company is they are bringing this technology to other companies, using them as a technology partner, for instance, Aston Martin, Mercedes, and even a bunch of aerospace companies. So that's the big bet on Zinger and the future.
I mean, Prost, that thing is gorgeous. It almost looks like a Batmobile. What does something like that cost for the 3D printed version? Did they give you a ballpark, perhaps?
This car is probably around $3 to $5 million, depending on spec, and maybe even more. They've had a couple of versions of this car coming out, and Q4, actually, I should mention, is they're going to start delivering the car in Q4 of this year. And they have plans to expand to around 30 factories to build not just this car, but mostly of the other parts and stuff for other companies. But Rochelle, the car is very, very cool. And we had a number of people that were coming up to us and bothering us during the shoot because they couldn't keep their eyes off the thing in Lower Manhattan.
Man, if they knock a few more zeros off the price tag, maybe I have a chance. But, I mean, it's gorgeous, though. Thank you, as always. Prost Subramanian there for us. Thanks so much. All right, we've got all your markets action still ahead. Stay tuned. You're watching Yahoo Finance.
If there was one streaming service that you had to cut, what would it be?
Oh, I have to admit, I've been a little annoyed with Max. It's so hard. Like, every time I want to download stuff, it's so limited. I find it challenging.
Have you finished everything that you wanted to watch on there, and now you're just kind of like, all right, I'm good to go here?
Yeah, I mean, I took a trip to Hawaii for a work trip, and I was on the plane so long, I needed more. And I have to share it with my husband, so that makes it challenging, you know, like, because he wants to download a lot too, so.
Certainly.
Yeah.
Neuralink, the controversial biotechnology startup founded by Elon Musk in 2016, received the green light to start human trials in May. Now the company has opened up recruitment for those looking to involve themselves. Let's bring in Yahoo Finance's Anjali Khemlani to give us those details. Hey, Anjali.
Hey, Rochelle, that's right. So we know, of course, as you mentioned, controversial, but starting in humans now with that FDA green light in May, the company is now starting to enroll candidates for that, but there are some specifics that go into it. But first, let's figure out what's going on. This is the N1 implant. That's the one that has 1,024 channels extending from 64 threads to be implanted in the brain. We've already seen some studies done preclinical in monkeys. That has been sort of the path that got the company to this point. The study is going to have a primary focus for about 18 months and then a follow-up for about 5 years. So it's looking at about a 6-year timeline total for this clinical trial. And who qualifies? 22 years old and older, anyone who has quadriplegia due to spinal cord injury or ALS, and has a consistent caregiver at home to help in case of anything. Those who have already other devices in their body, such as pacemakers, are not qualified. Those who have a history of seizures or need regular MRIs for current condition maintenance, or those who are getting a type of treatment for depression and anxiety that includes pulses. Those are the individuals who do not qualify. So it's a very specific subset that they're starting off with looking at for this. And of course, this comes at a time where there is still some questions around the previous study with those monkeys, as I mentioned, whether or not they were severely impacted by the use of this brain chip. But with that FDA green light, there's definitely some focus on how the FDA will handle all this, what data comes out in this initial part of the trial, and that will sort of inform what happens next. So it's a very interesting start. It's a very exciting start for this clinical trial, of course, but a lot of sort of wariness around what is happening with Neuralink right now.
Indeed, and appreciate you breaking down some of the specific groups who do qualify for this. I'm sure a lot of Musk enthusiasts thought they were going to sign right up for that, but it really is health that he's prioritizing with these clinical trials at the moment. Appreciate you joining us, as always, Anjali Khemlani there. Right, shifting gears, looking at the fight against inflation, the Federal Reserve has been raising interest rates, of course, for over a year. It may be what the central bank wants to see to staunch inflation long term, but higher for longer rates are having an impact on households that need to borrow cash in this new environment. Now, according to the New York Fed, nearly 60% of households said it's more difficult to get credit than a year ago. And data from LexisNexis Risk Solutions has found that there's been a 35% increase since the year prior in Americans using payday and other short-term loans. Now, that's around 1.6 million people who took out one of those types of loans for the first time in a year or longer, which, of course, carry higher interest rates than longer-term loans. Then, of course, the real estate market is seeing the pain the most. High rates can be costly to the monthly mortgage payments. According to the Atlanta Fed, the median American household has needed 43% more income to cover their payments. And that's a level that Americans haven't seen since 2006. Well, shifting gears, looking at Darden restaurants who beat Wall Street's quarterly sales and profit expectations Thursday morning. And while high menu prices and easing cost pressures helped the company's Q1 results, Darden said the consumer is certainly being more selective. Let's bring in Peter Saleh, BTIG Managing Director and Restaurant Analyst. Good to have you on the show this morning here. Now, we obviously saw they made a lot of investments here when it came to some of their steak restaurants, but it was Olive Garden who ended up being the champion of this quarter. Walk us through some of the data that you focused on.
Yeah, great. So thanks for having me on. Yeah, no, look, it was a good quarter, a solid quarter. They put up a beat on same-store sales, margins, EBITDA, and EPS. They took share across the category. Their gap to the industry benchmark was more than 400 basis points on same-store sales and more than 400 basis points on traffic as well. So they're definitely taking share and doing a good job on terms of driving growth. I think we are also seeing inflation starting to moderate, so that's more good news. Here we're seeing commodity inflation of just 1%. That's the lowest we've seen in several years. Labor inflation still, pretty stubborn, but they did mention that they're starting to see some improvements on labor as well in terms of hiring wages for the new hires and the availability of labor. So a lot of good to point to here overall for Darden.
And I want to break some of this down into their segments, because as we look at their fine dining segment, that saw a 2.1% drop in comparable sales in the quarter. We're seeing Capital Grille, Ruth Chris Steakhouse, that consumers are trading down, in fact, to even lower priced alcohol compared to last year, according to their CFO. How much of a focus then, given how much of an investment they've made on the fine dining in the past year, how concerned should we be about that aspect?
Yeah, so it is a little concerning what we're seeing in terms of the behavior of the consumer. So within fine dining and those consumers earning $125,000 or more per year, you saw a substantial move to lower priced alcohol or less alcohol, just trading down within the menu, trying to save a little bit of money. Keep in mind, though, that I think we've heard this several times, that last year was there was a lot more people just going out to eat, more fine dining sales. They were up maybe 120, 117% above pre-COVID levels. And so they're starting to kind of come down to more in line with pre-COVID levels right now in terms of fine dining. But we're also starting to see within their core brands, Olive Garden and Longhorn, some of that kind of trade down within the menu as well, to save a few bucks among consumers. So I think that was one of the themes that we heard from this call this morning, was that some consumers being a little bit more selective, a little bit more on the higher end, a little bit less so on the lower end.
I want to ask you, because when you consider food inflation, I mean, Darden added 77 Ruth Chris Steakhouse restaurants during the quarter. But when you look at things like not just food inflation on things like beef, you also have higher wages, a lot of these companies having to pay more. And some of these companies are passing those on by including the gratuities in the check, making it even tougher for the consumer. How risky is this to keep taking on these restaurants and expanding when the consumer continues to be squeezed?
Yeah, look, I think as you see it everywhere in consumer, prices are going higher or have been going higher. I think we'll see that moderate as we go forward. So pricing this quarter was 6%. Total inflation was 3%. So it was actually double. But that's not typically what Darden does. Typically, Darden has less pricing than inflation, and they eat some of that inflation. So I think what you're going to see going forward is that pricing is going to moderate significantly. Hopefully we get the same on commodities and labor as well. But keep in mind, labor inflation is still running around 6%. I don't know that we're going to really see a lot of moderation on that line. So restaurants are still taking some price to try and offset that. But the commodities are definitely more in flux at this point.
And in terms of as we look at the investment here and some of the companies that you cover in this space, how well positioned is Darden going forward, especially as you have uncertain economic conditions depending on how the Fed decides to move later on in the year, and you've got student loan repayments coming in. So with a lot of these factors coming in, higher gas prices as well, of course, how well positioned is Darden versus some of its competition?
Yeah, I think you hit on it, right? There's a lot of uncertainty out there. Student loan, restart, higher interest rates, all that is to a certain extent going to weigh on the consumer. Look, Darden's the largest casual diner out there across the country. They have brands from lower income to higher income. They span the gamut. I think they're probably one of the best positioned companies to weather any sort of consumer slowdown or any sort of storm that may be coming. So I think they'll do fine. The question is, does everybody feel this pain if consumers do slow down? I think we're starting to see some evidence, again, with that mix impact, that consumers are being more selective. Does it get worse? Nobody knows. But I think Darden is well positioned to weather it if we do see a slowdown.
Appreciate you joining me this morning. Peter Saleh there, BTIG Managing Director and Restaurant Analyst. Thank you so much.
Thank you.
All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Tons of great economic analysis, markets analysis as well, but you're also training for the New York Marathon. What is your number one tip for all the runners out there that are perhaps trying to get their miles in and see you when they're running throughout the 5 boroughs here in New York later?
Yeah. Well, first of all, you have to be really determined to do it. Do not give up, because as much as it can be very painful and exhausting, when you get through that, you feel great. So just keep going. And keep training with consistency. You can't slack off, so to speak. You got to do it every other day, I would say, or every 2 days, and really put in the work. You'll make it.
The UAW is threatening to expand its targeted strike if no major progress is made in negotiations by the big 3 automakers. So far, just 3 plants in Michigan, Missouri and Ohio have seen workers walk out. Though not widespread, striking members have effectively hampered the industry's largest supply chain. In the weeks leading up to the strike, automakers tried to guess which sites the workers would target and reorganize production accordingly. In his latest report for The Intercept, investigative reporter Daniel Boguslaw found that the big 3 guessed wrong. Daniel joins us now with more. Good to see you here, Daniel. So this does seem to be symptomatic of really the big 3 not really understanding what the workers are really up to at the moment. Break down this article for us and really the position that the automakers have put themselves in.
Sure. Thanks for having me. Well, really what we're seeing is a unprecedented in recent years tactic coming from the UAW. Instead of a mass walk-off at every plant, a big week-long show of force, which would cost the union strike fund hundreds of thousands of dollars, they've instead opted for a much more targeted approach. Spreading chaos, spreading confusion, keeping the big 3 on their toes by not announcing which plants were going to be targeted ahead of time, and ultimately forcing the companies to move engine blocks across the country in anticipation, shut down paint divisions within their different factories, all trying to guess what this union is up to, and effectively, as one member told me, striking themselves in the process.
And so with that in mind then, I mean, how long can this really continue before it does specifically start to hurt those who are protesting? I mean, they have a set amount of money in the strike fund. If they do expand to more plants, how quickly does that then get blown through?
Sure. Well, Sean Fain, the new militant president of the UAW, has said they're willing to go as long as they need to win their demands. That includes eliminating the tiered structure, which separates workers' wages and benefits by their seniority. It means a 40% pay increase, and it means a restoration of the benefits that workers have lost. I think that this is a new era for organized labor. This is not the same old Hoffa dynasty that has ruled for decades. And as Fain has come out swinging all week and made clear, they're willing to go as long as they need to with a new tactic, which is going to allow them to continue targeted strikes much longer than unions have in the past and recent decades due to these mass walk-offs, which have been extremely expensive. With this new tactic, they have a lot more time to draw out pain from the big three.
So then with that strategy in mind then, what sort of strategy would the big three then have to adapt? What are they going to do in terms of perhaps bringing in non-union workers or perhaps shutting down other plants and sort of trying to consolidate while this goes on? How would their strategy need to change?
Sure. Well, I've definitely heard whispers of scab workers being brought in, but I think ultimately they're not just caught off guard by these tactics; they're caught off guard by the entire new alignment, the new positioning of this militant union. I mean, in the past, if you look at UAW's history over the past decade, there were a dozen federal investigations into union corruption. The union was cutting backroom deals with management. And so I think you will see some of those tactics. I think you will see some of those traditional management strategies of trying to supplement workers. They've already laid off several hundred employees at one of their plants, which some workers are describing as retaliation. But I think they're really going to find that even with these tried and true strategies, which have been used in the past, they're dealing with a new beast. They're dealing with a new entity. And I think just as their anticipation of this strike failed during the first round of plant strikes, trying to enact these same old strategies with a union movement, which has proved extraordinarily popular with the American populace, is going to prove similarly difficult.
So then, Daniel, as we look at the proposals that the big three have put forward there, are they essentially dead on arrival? Is it an all or nothing situation at this point? When you look at the cost of living, when you look at, housing costs, people trying to, make it through their day, high inflation, are these proposals going to be dead on arrival then?
Well, I think Sean Fain, UAW president, answered that when the initial contract that was offered was summarily thrown in the trash can on live video by him in a live broadcast video. So I think looking at the UPS Teamsters strike, they were not messing around. They threatened to shut down the entire consumer delivery supply chain across the country, and they won a shocking number of their demands. They won pay increases. They won a lot of the benefits in their trucks that workers were demanding. They won the elimination of the tier system, which was a primary goal. So I think I think just like the Teamsters, the UAW has their sights set very high. I think they're not. I think they're going to be willing to negotiate to some degree, so that the companies can maybe try to save face with their shareholders. But in the end of the day, I don't think that they're going to take a half-baked deal. And I think their rhetoric and actions thus far have made that clear.
And so when you think of where the future of automation is headed, when you think of AI, more of these things that require less physical labor, how important is the stand that both the automakers make in this part as they invest more into this technology, trying to spend more to keep up in the EV race, while also trying to balance here with the workers as well, who are wondering about losing their jobs? How important is the stand for both of them right now?
I think it's critical. I think that's absolutely right. I think we're in a really important turning point right now in terms of automation. And I think it means winning the highest level of benefits, the highest pay scales ensuring that those unions are strong, that they're well financed, that their workers are fairly compensated, so that they have that base to continue organizing, to continue expanding. UAW President Sean Fain said this week, this is not just about our fight. This is about the world that we want to live in as workers. This is about a fight that extends beyond auto manufacturers. It's one that extends to all sorts of different industries. And the stronger each individual union is, the better chance workers have across the board, across industries, to safeguard their jobs, safeguard their benefits, and ensure that automation does not eat into those strong American manufacturing jobs that have been the bedrock of U.S. production and manufacturing.
Does seem like we're in a new era for this. I do appreciate you joining me. Daniel Boguslaw, The Intercept investigative reporter. Thank you so much for that update. Appreciate it. That does it for now. I'm Rochelle Akufo. I'll see you tomorrow.